A good investor combines passionate curiosity with the relentless pursuit of truth, integrating a diverse set of information to gain unique insights. Creatively connect unrelated data, continuously accumulating knowledge, be a learning machine.
For me, a safe and supportive organizational culture is essential. It thrives on open disagreement, collaborative learning from failures and successes, and mutual care. Cultivating this environment requires collective effort, but ultimately elevates an organization beyond the individual's contributions.
For me, a good investor is someone who has a good strategy, really understands the market, really understands your portfolio, why the stuff you do makes sense. And second is execution. How you step into positions, how you step out of positions, how you manage risks and drawdowns. If you have both of those, a good strategy and sound execution, then you actually might be onto something.
A good investor needs to be confident enough to follow your conviction and take contrarian bets, going against market consensus, because popular opinion is not always correct. However, beware of your ego. Be open and humble enough to change your mind when new information appears.
So how do you actually become a better investor? That is the topic for today's conference here at Norges Bank. What we just saw was 4 of our best and brightest portfolio managers in the fund talking about what, in their opinion, makes a good investor.
Today, we get to dive deep into this question and learn from the very best. And it is our great pleasure to welcome you all. I'm Shilpi Nanda.
And I'm Trond Grande. We are your hosts for today. And wow, are we looking forward to it?
Absolutely, Trond, we are. And an extra warm welcome to those watching us live. It is our hope that today would be an exciting, inspiring, and an interesting afternoon with us. So today is all about learning the secret sauce of what makes a better investor. Some might even say an excellent investor. And so we have 4 exciting sessions lined up for you on investment philosophy and strategy, on building successful investment organizations, the psychological elements that go on to making better investors, and the behavioral aspects of excellent investors.
And so it's time to kick it off, the first session on investment philosophy and strategy, with our first speaker of the day. Greg Jensen is a founder, not founder, but you're the CIO, sorry, of Bridgewater Associates, where he oversees their investment engine. Not only is he an excellent investor, Greg also is one of the top 100 people in AI, and he is also a gold bracelet holder from the World Series of Poker. So please join me in welcoming Greg to the stage.
Thank you.
Well, thank you for having me. So when I think about our philosophy, right, and this is really about the philosophy that gets you to be excellent, excellence is so core to us, and as I go through the different words that define our philosophy, I think it's trying to really focus on what do you mean by a buzzword like excellence. And for us, we measure excellence by what we mean by it is continuous improvement. Everybody starts somewhere, and the question is, can you as an individual and you as an organization continuously improve? That's what we would define as excellent. And so if I start with what, let's see if I got this here. What are we trying to be excellent at? And Bridgewater's been doing 2 things for its whole existence, 50 years. I've been at Bridgewater for 29 years. And we focus on 2 things, which is to deeply understand how the economic system works and apply that to build great portfolios. So we're trying as an organization to be excellent at that, which means to continuously improve that. And there's 3 components that are critical to really understand our philosophy. One is what we mean by fundamental. So fundamental means what actually drives markets, that we believe that you can understand this, that there are decisions that people make, they make them for reasons, those reasons add up to what we consider the fundamentals. That those ideas can be, you can think of them qualitatively. They're not like, not everything that you're thinking matters is measurable in a traditional qualitative sense. But in any event, that's what we mean by fundamental, which is what are the true causes for the things that you see in the world. And then the second step that we take is to take whatever you believe and systemize it. What we mean by that is have the rigor to take the reason that's in your brain, right? It can be a qualitative idea, but there is a reason. The synapses in your brain are doing what they're doing. And somehow there are inputs coming in, there's logic being applied to those inputs, and outputs coming out. You can take the energy to systemize that understanding, and it's critical. I'll talk about why that, for us anyway, that's so important. And the last thing is have a strategy for being wrong. Our strategy for being wrong is diversifying, but there's different strategies, but you need to know that whatever you believe, with whatever confidence, you're going to be wrong a tremendous amount. So those are the three kind of core things I'll dig a little bit deeper on. So first off, what could we mean by fundamental? What are truths that when we try to discover what's true about markets and economies, there are things that are going to be true now, that are true wherever you place yourself in the world, that are true at any moment in history, and we expect to be true at any moment in the future. I mean, the first one of those things we'd start with is that there's two core ways to make money in markets. One is to take on risk. That's a risk transfer to you, that somebody's offering to pay you because you're in a position to take risk they don't want to take, right? That's what that general category, we call that beta. Not to be too, like there's semantic arguments about what beta means, but for us, we just mean the amount of money you get paid for taking on somebody else's risk. Then there's a separate point, which is alpha, which is the money you can make by making smart decisions in terms of timing, in terms of valuation, et cetera, that go beyond just taking on the risk. So we think about trying to separate that and think of every investment as the risk-neutral position plus the beta, so what the asset classes are that you hold and the risk that you're transferring, plus the alpha. That's very different. The way we look at it, that sort of formula of how you get a total portfolio return, is different than how most organizations structure their investments. Most organizations think of their total return as their holdings in each asset class, holdings in stocks, holdings in bonds, holdings in private equity, et cetera, and those sum up. Right? And the difference is you don't have to combine your alpha with your beta. You can separate those two decisions, and that's a big deal. So first off, understanding those two return streams, recognizing they're different, and the way you can combine them together can actually significantly improve how you invest. So now when we come back to fundamentals and we think about what are fundamentals that are timeless and universal, what can you say about markets that's going to be true 100 years from now, is true in China, is true in the United States, is true here in Norway? Because you really want to base your beliefs on things that are fundamentally true and then build out the deep understanding about those things. So to give you two examples of what we mean by things that are timeless and universal, that the first is that the price of anything is equal to the amount of currency spent on it divided by its quantity, right? That seems simple, but it's actually a world of understanding to say, well, how much money is going to be spent on something? How much supply of it exists, right? And you can fundamentally build that, and you can build that in any time, in any country. And I'll get into how we check that those things are true anywhere. Similarly, the price of something is equal to the discounted economic conditions that affect it. And so when you look at the changes in prices, it's because something happens relative to the discounted economic conditions in that asset. Those two things are true all the time and everywhere, and those are big building blocks to then build a process around. So when we've been building processes to measure that, to measure those cause-effect linkages of things that we believe to be true, really starting in 1980. So the first thing I'd say now, we'll talk about making decisions systematically. Why do you do this? It's such a pain, right? Why do I have to write down what I believe? Why do I have to stress test whether it's true? I mean, most people want to skip that step because it's like, okay, it seems like this is going to happen or that's going to happen. And it's been such a huge building block in our organization to say, no, we're going to have the discipline to always write down our reasoning, right? So when we talk about making decisions systematically, this is not a quantitative thing. This is about having the discipline to say, this is why I'm doing what I'm doing. That opens up a world. So if you look at the yellow piece of paper that's up there, that was our 1980 bond system. So in 1980, you can picture Bridgewater, it was yellow piece of paper, rules that were written out. This is, we're going to buy bonds if this happens, we're going to sell bonds if that happens. That were rules about what thought about money supply and other things at the time. The idea itself is not that useful, but the process that it kicked off was critical, which is we just scratched out one of those ideas, put in another one, learned another one. But you start with this building block of what do you believe, so that others in the organization can question that. It's forcing you to actually state what your logic is. And that allows constant compound improvement. That's really such a critical element to our philosophy. And the benefit of that is you can check yourself. So what I'm showing here is just an example. If you said, okay, let me say what I think, right? Right now, you might think, well, the capacity utilization in the United States, like the economy's running hot, and that running hot could lead to higher wages and maybe higher inflation, and therefore I want to take this position in markets, right? And the great thing about forcing yourself to, okay, that seems reasonable. Like, let's write it down. Let's see if that's true. When is it true? If you use that rule, will it actually work in history, right? Force yourself through that. Put yourself at different points in time. That'll force you to refine your thinking, right? If you just take that idea, that's like just something I've recently heard a fair amount, so I just wrote it down so it could show. And then you could have technology to just test, okay, well, let's say you follow that rule. Does it work or not? And what you find most of the time is actually a lot of time it doesn't work. So now you think, well, I must not know. What I'm saying isn't that reliable, right? And I show like a profit curve of the alpha of that rule, and it's actually okay for a long period of time and then flat for the last 35 years. Why would that be? Why is that getting priced into markets? What's going on, right? And the benefit of writing down your rules is you could actually see whether they work. And that's a huge, huge deal. Beyond that, you can also know what you're in for. For every idea that we ever use to invest, we start with what do we expect from it, right? And so this cone chart illustrates this. But every idea that we use in investing, we say, okay, what are the risk and the return that we expect from this idea in the future? And that gives us an opportunity to then compare what happens relative to that, right? So the cone chart is when we first started the idea. So in 1991, as an example, we started the idea of pure alpha, which is all of the alpha ideas we had at the time put together, and then we've added to them and subtracted from them. But, and we set out a cone chart and said, this is what we expect the risk return to look like into the future. And every day we mark what's happening relative to that expectation, right? And we do that with every single idea, which is automatic quality control. You could say, okay, if my idea doesn't work out consistent with how I expected it to, then, okay, the world's different than what I thought. And on the other hand, if there are drawdowns in that idea, which there always will be, you plan for it in advance. You're not reacting to that drawdown. You're saying, okay, if I have a drawdown of this nature, I'm not perplexed by it because I knew it would happen. I expected that to happen. So knowing what's inside the bounds of what you expect and what's not is another critical element. Now, the next point is probably the one that's most sort of under fire at this point in history because diversification hasn't been doing that great as a concept. But if we thought about the holy grail of investing, right? What do we actually want if you want to achieve your goals in investing? It's to have something like 15 to 20 uncorrelated return streams. This is kind of what we're seeking. You never actually get there because things are too correlated to quite get to that level. But if you're seeking ways that you can make money in markets that are unrelated, right? And the benefit of that is you can translate, if you basically look at this chart, most things, if you take most of the investments that you're all invested in, are reasonably highly correlated. They're on the top left. That means you can buy a whole bunch of them. You're not actually getting much diversification if you see this curve. If you're able to select strategies that are uncorrelated and you can move down that curve, you can improve your reliability 3, 5x with equally good ideas if you're getting uncorrelated ones. So that is really that seeking, that search for what are our paths to get positively expected returns that are uncorrelated to each other. So that's, again, a hugely important part of our philosophy. And to do that, what you need is to put them together in a way that actually works. So when you do balancing and diversifying in terms of risk instead of in terms of capital is so critical. So it's usually people think in terms of, okay, I'm going to invest X in this asset, Y in this asset, et cetera, in capital terms. Restructuring your thinking to think in terms of, I'm going to allocate risk to different things, and then I'm going to try to balance that risk among things that are diversifying. So that means you have to take high-risk strategies and to lower the risk on them, and take low-risk strategies and raise the risk on them in order to get diversification across them, right? And that's another attribute of when we're thinking about diversifying. Now, to slow down a second, just to put that into practice, right? So when you think about the concepts that are behind pure alpha, that is sort of the best we could do in generating alpha in the world. The concepts start with the deep understanding of the world. Having studied everything that exists in the world that we can think of for 50 years, taking that yellow piece of paper, crossing out things we don't like, adding things we learn, building those into algorithms that reflect everything that we've ever thought of, right? This kind of gives you a sense of how that literally works. So it starts with different ideas on the left here. That A, you'll have different approaches to trading the market. This is, again, part of diversifying, right? You might think in terms of fundamental principle of value, that eventually that the cash flow of an asset is going to equal the present value of all the future returns that you'll get. You could build that deep understanding of what causes that, what an asset should be worth today, right? That can be one perspective on that market. That isn't going to help you that much in the next 6 to 18 months. It helps to some degree. It won't help you that much. So you need other perspectives. Well, what are the other drivers beyond value, right? We think of essentially the movement in the fundamental conditions that matter. So how do you measure those? How do you build that into a decision rule? We also think about the effect that other markets have on that particular market. Again, how do you build that whole world out? Why do other markets affect this market? How does that actually work? And then the fourth thing is who all the buyers and sellers are. One of the reasons things go far from fair value is because buyers and sellers do things for reasons other than the long-term cash flow effect. And understanding the balance sheets of those players, where they get their money from, how that works, those pieces all combine together. And you could think of it as we have all of those ideas that we've been working on for years. You could think of it as four people arguing with each other with different perspectives on markets that you then put together to get to a view in a market, which is kind of then the thing that's on the next diagram here on the chart, which is, okay, you could translate those different people's views into a systematic process. Build that systematic process to combine that information into one view of a market, right? So that we take that second step. Then we take those signals that we've combined together and build that into a risk pie. So say, okay, well, how much risk do we want to put on each one of those strategies? How much risk would we put in each one of the markets? Again, trying to move ourselves as much as possible to the holy grail of 15 or 20 uncorrelated return streams. And that's then, the pie chart shows the risk budget we try to get over time, which is a very balanced risk budget across many different markets, across very many different strategies across those markets. But at a point in time, which is then the furthest right chart, you're not going to have views on everything. That's another big, important philosophical thing, is you don't have to have a view on everything. You have this world of opportunities to take advantage of. You don't have to have a view on everything. So translating your views at a point in time, that things that you have strong views on, through a risk budget that's an across-time risk budget, you can sort of multiply the signal by the risk budget to get the overall portfolio that you end up with. So that's how we kind of put these pieces together in an approach that starts with qualitative thinking about, from experts on, like, why would you buy a bond? Why would you buy a currency, et cetera, et cetera. Translating that qualitative thinking interrogating it until you could translate it into an algorithm, using those algorithms to look everywhere in the world so you could be massively diversified, because now if you've actually taken the logic of why would you buy a bond, why would you buy a currency, you could apply that anywhere in the world. If you've done it well and deeply, you could apply it everywhere. So you could apply those rules while you're not even realizing something's happening in a country or whatever. And you could build out a portfolio that way, measuring point-in-time conditions, reflecting all that logic that you've built up over 50 years of compounding. Right? And that's kind of the last point that I'd say. If you just talk about our philosophy, it starts with constant improvement. And if you actually do constant improvement as an organization and you compound that understanding, right? You think about compound returns in the context of an investment. If you think of it in terms of an organization, what you really want to do is compound understanding. Like, what does the organization actually know? And how do you keep building that out? Right? And so this diagram on the left, it's going to be a little hard to say, but basically this is my view of the 3 pieces that we've been doing to build out our understanding that allows us to compound as an organization. The first is what's reflected by that cube, which is that everything we've ever learned at Bridgewater that we thought has value, we have translated that into an algorithm. That that algorithm itself is data that's been stored. Everything we've ever learned about currencies, bonds, economies, growth, inflation, everything's been learned. Everything is stored in a way that's organized such that you can find it, you can utilize it, others can build upon it. We make everything that we've done, we have the standard of it has to be computer readable, which means we run it 3 times a day, it's always updated, it's always got the newest information, and human readable, which means that a human expert can look at this and understand it. An investor can see this, it's not buried in code, but that it's available, everything that we've ever learned. That's what the cube represents. Now, to have an organization of hundreds of people working on that cube, you need what the pyramid represents, which is, well, how do you do it? When you learn something, where do you put it? How do you reflect your qualitative understanding in ways that then others can access? Right? So the pyramid, and what we have in there is essentially our rule book of how you go about from an idea to getting the data you need to fuel the idea, to building the visualizations that other people need to understand your idea. Right? And so that is the second component of it. And then the third component of it is the circle around it, which reflects the learning process, the constant learning process. You'll always be wrong about a ton. We have 2 inputs into our process. One is the basic circle, which is we're constantly making predictions about the world. We're constantly getting them wrong. We're constantly learning by digesting why that happened, looking back and building that out. Then there's also inputs in the world, something you've never thought of before, new things happening, right? And the great thing about having a systematic process is you could spend all your time on what you might be missing in that systematic process. How do you deal with geopolitical tensions and tariffs and changes in trade patterns, et cetera? You might not have that in your process, but if you have a process that reflects everything you think about, you can spend all your effort on the new problems. Right? And the chart on the right is kind of what I want to leave you with. It's the compounding point. That if you start, this is true of investments, obviously, but true in an organization and understanding. If you start with a basic level of understanding in 1980 on a piece of paper, and you keep crossing things out and learning and learning and learning, and that thing is not in your head, so it doesn't leave when you leave, but it's actually reflected in that process that others can build on, your understanding follows a compound return curve as an organization the same way that an investment can if you continue to compound. So that's our philosophy.
Thanks, Greg, for sharing your insights. We really enjoyed that. Our next speaker for today is Harvard Marx from Oaktree Capital Management. Now, Harvard has a passion for contrarian investing. He's not only a world-renowned investor, but also an art enthusiast and an author. We're really lucky to have you in person with us today, Harvard. Would you like to join me on the stage?
There he is. His hand went down. I want to thank Greg for sharing his knowledge with us today, and Nikolai and NBIM for hosting us today. And when I was offered the chance to discuss investment philosophy, I said, there's no way I'd rather spend my birthday. I'm extremely interested in investment philosophy. I think it has to undergird everything we do. My argument is that our behavior has to be well thought out and intentional. And so our methodology has to be as well. You'll hear that it's different, but at least we have thought it out, and it is intentional. It starts with a conscious decision as to what you want to accomplish. Now, this may sound easy. Well, we want to have more money rather than less. We want to have a higher return rather than less. But the starting question for any organization in investing should be, will we settle for average, or do we want to try to be above average? Now, that sounds like an easy one. But you have to recognize that in investing, it's extremely easy to be average. You can buy off-the-shelf products that will guarantee you that you'll do average. Or you can try to be above average, which is extremely difficult. And there is no surefire solution to how to get there. And if you try to be above average, it exposes you to the risk of being below average. The two are inseparable. So thoughtfully, consciously, intentionally, which is it for you and your organization? Next, I believe that an organization has to have a creed, a religion, the things it believes in, the things it doesn't believe in, the things it will do, the things it won't do because it doesn't trust them. And you have to stick to it. And again, it has to be conscious and intentional. Now, I wish the print was bigger so I could see it. I could probably see it if I do a little bit of this. But the truth is, we have to make decisions. What will be our intention? What do we believe in? Will we trust macro forecasting, or will we abstain from it? Will we, pardon me, how do you think about risk? Will you take a high-risk approach or a low-risk approach? Which is your route to success? It's not the same for everybody. Do you believe in the efficient market? This is extremely important. It's the most important concept I took away from my graduate education at the University of Chicago in the late 60s. Many people understand the concept. Very few people incorporate it and think about it in their daily lives. These are some of the things that we have to consider. So let's talk first about the concept of market efficiency. Now, the theory of market efficiency is that there are a lot of people out there, and they're all numerate, intelligent, highly motivated, objective, and rational. And they all want to accomplish the thing you do, which is to end up with more money than you started with. Given the scope of competition, how will you be the one who accomplishes the goal rather than them? Not easily thought out. Now, what we call the strong form of the efficient market hypothesis says that due to these circumstances, all information is immediately incorporated into the price of assets, to the extent that no one person can figure out which are the bargains and which are the overpricings. Now, the really strong form is actually a little different. It says that the prices of assets as a result of this intensive process are always right. You can't beat them, and so you can't beat the market. Now, I don't think that's right. I think the prices are not necessarily right. They're just the best that the consensus can do, and it's hard for any one person to be smarter than the consensus consistently. Two different things, but the bottom line on both is the same. You can't beat the market. So the question is, do you accept that? And that pushes you toward a passive approach, targeting average performance, low cost, low risk, highly likely to succeed to accomplish your objective, which is being average? Or will you try to be above average in the face of the very strong competition that exists? Will you endure the costs? Will your pursuit of being above average permit you to be exposed to the risk of being below average? And will you engage in this pursuit of superior performance, which is not that likely to succeed? The first thing I learned at the University of Chicago was that on average, most people do average before fees and below average after fees. And the thought at the time, 1968, was, well, why don't they just buy one share of every stock in the S&P 500? There was no discussion of index funds or indexation. These had yet to be invented, basically by Jack Bogle at Vanguard in '74. But you can see where the concept went. And today, most mutual fund equity capital is managed passively or through indexation. So it was not irrelevant. It was persuasive. Will you try to be active and be above average, or passive and be average? Do you have the people in hand who can accomplish it, or the ability to find those people and hire them as outside managers? What happens at the moment when average performance is X, and a few people publish performance which is much better? And your bosses say, who's the idiot who signed on for average performance? So these are questions, but it's very fundamental to the selection of an investment approach to understand and reflect the concept of market efficiency. The next is knowing where returns come from. You can have an average portfolio and do average, or you can say, well, this is a company that I think is going to deliver positive news which is unanticipated by others, positive surprises. And if you can figure out which ones will deliver positive surprises, you can overweight your portfolio toward those. And then when the news comes out and it conforms with your view, everybody else says, oh, I wish I had more. They go out and buy it. That forces the price up. You are an above average performer. So that's the route. How regularly can it be accomplished? That's the question. If you think different from others, you have what we call a deviant perception. How often will you be right, as opposed to the consensus being right and you being wrong? This is at the heart of things. Again, you're up against intelligent competition. And when I started my career at a large and bureaucratic institution in the equity department, people would ask, well, what do you think you can make for us? And the answer was 12%. Well, how do you arrive at 12? Well, the S&P 500 does 10 on average, has done at that point in time for 60 years. So if you can get 10 without any effort, you should be able to get, well, let's say 20% better with a little elbow grease. In other words, 12. But what if all the elbow grease in the world doesn't accomplish anything because the market's efficient and you can't get an advantage? Then it's not only a waste of effort, but it's a waste of management fees. And of course, management fees are the only certainty in the investing world. Now, another important question is, will you bet on macro forecasts? Everybody makes macro forecasts. And yet, I don't believe that they are of any use. That's a mild exaggeration, but not so great. The truth of the matter is that most of the time, things continue as they are. So a forecast of extrapolation is correct most of the time. And most people share that view. Most people expect extrapolation. Extrapolation of the recent trends, the long-term trends, is incorporated in security prices. So when the extrapolation turns out to be correct, it's not a profitable expectation because everybody else had it as well. It was in the price you paid. The forecasts that are very profitable are the ones that call for radical deviation from trend, radical deviation from extrapolation. These are very significant when you make them and they're right. The trouble is they're not right very often because most of the time things are extrapolated. And so we have forecasts of extrapolation, which are usually correct but not profitable, and forecasts of deviation from trend, which are potentially very profitable but not often correct. I take that analysis to mean macro forecasting doesn't work. And when we started Oaktree 29 years ago this month, we sat down and we wrote out the things we had been doing, because we had the benefit of having worked together for 9 years already on average. And we have a very simple investment philosophy of 6 points, which governs everything we do. And number 5 says that our actions are not driven by macro forecasts. We are bottom-up investors selecting individual companies, not top-down selecting markets and countries. So that's a difference. We think we can get an advantage. By the way, where does outperforming come from? In short, it comes from having a knowledge advantage. And you have to know something better than most other people to outperform. Just trying is not going to help you if you don't know something they don't know. So we think we can get a knowledge advantage in studying the micro companies, industries, and securities, not the macro countries, markets, and rates, for example. So, you know, we bar that from our approach. One of my heroes is John Kenneth Galbraith, who said we have 2 kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I've known for decades that I don't know. So I think we have an advantage in that. And then that kind of sounds like forecasting, macro forecasting is unavailing, but the truth is that it can be worse than neutral in its effect. It can be damaging in its effect. And I quote the American humorist and novelist Mark Twain, who said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." No sentence that starts with, "I don't know, but," or "I could be wrong, but," ever got anybody into trouble. The ones that get you into trouble are the ones that say, "I'm sure that's such and such," because if you believe something strongly and you bet on it heavily and you're wrong, that's how you get into big trouble. So will you bet on macro forecasting? This, in my opinion, is a critical and overarching decision. I wrote a memo a year and a half ago, I think it was October of 22, entitled "The Illusion of Knowledge." And it's basically a rant against macro forecasting, starting with a famous quote in each section. I think it's extremely important to decide, will you or won't you start from a top-down macro forecast? And most people do. Many people know they don't work. They do it anyway. And I quote somebody in there as saying that most people couldn't get out of bed in the morning if they admitted how uncertain the future is. And so I believe that macro forecasting, in my view, often takes the form of, can I say, organized religion. It gives something to believe in to dispel the great uncertainty present in the world they live in. You know, I believe that very few people have the ability to do it in a superior fashion. Now, the next question is, how will you and your organization think about risk? What is risk? You know, in all the formula mathematical work in the investment business, people use variability of results as the measure of risk. I don't think that's the real risk. I think the real risk is the risk of bad outcomes. But the trouble with my form of risk is it's not measurable. You can't measure what the probability of bad outcomes is in the future. You can't even measure what the probability of bad outcomes was in the past. You can only measure what happened, which is a subset of what could have happened. On the last slide, I had a quote from Elroy Dimpson, who was a professor at the London Business School. He said, "Risk means more things can happen than will happen." The conventional view of risk is shown in this graphic here. You have return on the vertical axis, risk on the horizontal axis, and a line that slopes up and to the right. And mathematicians call this positive correlation. If one goes up, the other goes up. Most practitioners take this to mean that riskier assets have higher returns. There's something wrong with that formulation. If riskier assets could be counted on to have higher returns, by definition, they wouldn't be risky. So the way I look at it is more like this. I take these little bell-shaped curves, I superimpose them on the same line. It's the same underlying line. But now, as you move from left to right, not only does the expected return increase, but the range of possible outcomes gets wider, and the bad outcomes become worse. That, I think, is risk. That is what people should concern themselves, not the possibility that their return streams will be lumpy. Buffett said, "I'd rather have a lumpy 15 than a smooth 12." And I think that makes a lot of sense. So I think the most important job of the professional investor is to manage risk. And you know, Greg in his talk said, "What do you believe in?" And I think that's very important. And you could hear in his presentation how much of the time they devote to assessing, managing, and balancing risk. And we have to do the same thing. We have to assess it and manage it, even though we do it from a bottom-up micro level, not top-down. But I think that you have to constantly work with risk, but you have to never assume, as Mark Twain cautions, that you know it for certain. We never know what is going to happen, and the events show that in the world. We never know how the market will react to what happens in the short run. And if you want proof of those two statements, take a look at the US presidential election of 2016. Everybody was confident of two things. Hillary would win, 80% probable, and if by some quirk of fate Trump won, the market would collapse. Instead, Trump won, and the market went up for 14 months, 30%. So we don't know, and we don't ever assume that our intellectual process permits us to get the risk under control. And then, lastly, you have to accept that it's very hard to have both superior returns and low risk, a high degree of safety. Going for superior returns means taking some risk. You have to either bet on riskier companies, riskier propositions, things that are considered unpopular and out of favor, and things that, if you're wrong, will result in your being below average. And you have to figure out for yourself what your approach is. I'm a tennis player, and last summer, while watching the tennis tournaments, especially Wimbledon, I wrote a memo entitled, "Fewer Losers or More Winners." You have to have an approach, in my opinion, which will organize your pursuit of superior returns, and there's really two ways to do it. You have to either have more of the things that do above average, or less of the things that do below average. There is no alternative. Of course, you could do both. I think for most people, given their mentality, one or the other is more likely. The conservative person can, in theory, have fewer of the things that do poorly. The skilled, aggressive person can, in theory, have more of the things that do well. Each person has to understand their own mentality, what's possible for them, and thus what their pursuit will be. And these things, in my opinion, taken together, are examples of the elements that combine to produce an investment philosophy. And we've done it at Oaktree. Everybody knows where we stand. Everybody is pulling together in the same direction. Thank you very much. Okay. Good.
Thank you, Howard. since you are so kind to spend your birthday together with us, we did want to give you a small gift.
Thank you.
I'm not sure if you're aware, but there's actually 2 famous inventions that has come out of Norway. One is the paperclip, and the other one is the cheese slicer. Now, we thought it would be a pretty dull gift to give away paperclips, and hence we wanted to give you this cheese slicer in oak tree, I should add, and with a small piece of local cheese. So
and now I can go home and make my own open-faced sandwiches.
Excellent.
Thank you.
I can take this one, and if you want to take the seat, we'll go to the panel. Thanks again, Howard. So now we will have a panel discussion. Howard, Greg will come back on the stage, and they will be joined by Jean Hynes, who is CEO of Wellington Management, together with Patrick Healy, the CEO of Hellman & Friedman. The panel discussion will be moderated by our own Chief Investment Officer for Equities, Pedro Furtado Reis. Please give them a warm welcome.
It is such a privilege to have the 4 of you with us today. Greg, Howard, what a way to start this conference today. That was incredible. Thank you so much. We are now joined by Jean and Patrick, and we'll aim to take the discussion further. So if I interrupt any of you, please bear with me. This is just to make the most of the time that you have kindly given us. Jean, I'll start with you. So Greg and Howard ran through their investment philosophy and the need for an investment creed. You run Wellington, which can be seen as a federation of investment boutiques. What are really the advantages and the pitfalls of not having to have an overarching investment philosophy?
Thank you, and thank you for sharing all your insights. That was really fascinating. When I was sitting there listening, it made me think, you know, we have about 60 teams, like you said. We're not organized by one overarching philosophy and process. I guess our overarching philosophy and process is that we believe a philosophy and process is critical to the investment team. We have about 60 teams. And in each of those teams, we have a few in the audience today. Each of those teams have a very strong philosophy and process, very similar to what Greg and Howard do. And that's what they practice every day, and that's what they believe. We combine that at Wellington. I think every company has an edge. I think our edge is that we are really collaborative. So we have I've been at Wellington for 33 years. Over those 33 years, we have really broken down silos, and so that our long-only investors in equity collaborate with our fixed income colleagues, who collaborate with our private colleagues who do private assets and who do long-short. That's the secret sauce. Like, how do we don't have one CIO, we have 600 CIOs, and we have normalized debate, having different perspectives on any topic. And then each of those teams can go and practice their very well thought out, strongly held beliefs about how they're going to make money for clients. That's how we're organized.
Very good. Patrick, I'll pull you into the conversation. Does the private nature of what you do have any direct implications on your investment process? Is there anything intrinsically different between private market investing and public market investing?
Well, I suppose, given my diminutive nature, I might sound like the poster child for private equity. But I'll say, look, I think private equity is an advantaged asset class if you're going to be in the investment business. And you sort of start with just the structure. You know, we have a 5-year investment period. We can have the money invested for 10, maybe 12 years. So we don't have to be invested all the time. You can pick your spots. That's a huge advantage. You get to do inside diligence. That's an absolutely huge advantage. You get to choose and select your management teams. You get to borrow money, and I've been doing this for 30 years, and I can remember, my first 15 years, you actually borrowed money with covenants, but for the last 15 years, we get lent money without covenants. So that's sort of extraordinary. You get to choose when you want to sell a business, and you get to have alignment, in the boardroom. It's sort of the investors and the management team. You get to choose 3 to 4 things that you really want to go for. I think that's a huge advantage. So as we think about sort of our own investment process and sort of managing risk like Howard and Greg, talked about, it's really about being super micro-obsessed with the specifics of the business and ensuring that we, maintain our standards that way.
Mm-hmm. And you really invest for the long term, and that could be like a good segue into long-term investing. Greg, Howard, how do you incorporate, how does investment horizon fit into your investment philosophy and your investment or like philosophy creed?
Well, like Patrick says, maybe half of our assets are closed-end funds where you have the money for a period of time, and the great advantage is that the clients can't withdraw. So, people out of control of their situation love to buy when they're excited and sell when they're depressed. And this approach keeps them from doing so. That's one of the greatest advantages one can have in the investment business. I think that everybody at Oaktree understands our culture. We actually don't even have a tenet of our philosophy that talks about long-term investing. It's just understood. When I travel, especially to Europe, and people find out I'm in the investment business, they say, "Oh, what do you trade?" My back goes up. I said, "We don't trade. Trading is guessing what something's going to do tomorrow. We're investors. We're in it for the long term." And I think that everybody on this stage is more of an investor than a trader. I don't understand how one gets an advantage in the short term.
Mm-hmm. Running such a systematic strategy, Greg, do you agree?
Well, I think the main thing is, when I listen to Howard and what everybody on the stage is saying, I think the main thing is in the long term, you have to know what your advantage is. And that's the big thing, right? So for us, our time frame that we really understand well and we focus on is 6 to 18 months. So for some, that's very long term. For some, that's very short term. But 6 to 18 months is what we've thought really hard about and believe, despite Howard's thoughts on macro investing, that we have an edge in understanding what's happened in the world. Now, we are wrong a lot, to his point, and so you have to know how to be prepared for being wrong. And within macro, there's a lot of macro things going on, so you can diversify across many different things that you're talking about. But I think the starting point is that, and that the long term is going to work out if you know what your edge is, if you stick to it, if you're humble about it and you continue to learn. And long term is not going to work out if you're stuck on any particular thing that you might be wrong about and that you don't have a way of constantly improving and constantly learning. But for each of us, I think the main question is, what is the edge? Do you actually have it? And can you continue to improve it?
Mm-hmm. Jin, you are known as a very long-term investor in your portfolio manager days, which still one. How do you encourage your portfolio managers at Wellington to think long-term?
So part of it is our structure. Because we are a private partnership, we can incent investors, we can evaluate them, we develop them over long periods of time. So that structure enables that we are really paying our investors over, very aligned with our clients. I think that's one of the very key advantages. And then because we have 60 investors, like I'm one of the longest term, I'm probably very similar to Howard. I don't quite have a 12-year horizon, but I have a really low turnover. My turnover is 10 to 12%. It very much aligns with the industry that I invest in, which is a very long cycle, low turnover industry in healthcare. But there are others that have higher turnover, and so one of the things that we try to do is we do a lot of trading analytics. Are you making money off your trading if you have a shorter term time horizon? Back to what Greg said, what's your sweet spot of having insights and being able to. So there are some people who are fantastic who have high turnover, and then I strongly believe for me as an investor, having a low turnover strategy and really taking advantage of the insights I have over the long term is what has enabled me to do well over many years. But really having that self-awareness of how you generate insights, how you're going to make money for your clients with whatever asset class you have, I think is key to that.
Excellent. Howard, you touched on market efficiency and the importance of that. There's now endless information and a lot of noise in the market, but markets arguably become more efficient over time. So a question to both of you. How do you compare the alpha generation opportunity of your investment strategies now compared to, say, 10, 20 years ago?
I think it's gotten a lot harder over time, Pedro. You know, Warren Buffett talks about having bought dollars for 50 cents. 60 years ago, you could do that. 50, 40 years ago, I myself bought things that I thought, this can't exist. And yet, you got bargains virtually that couldn't miss. It's very hard today. If you think about it, everybody knows everything today. There's no such thing today as not knowing something if it's fact. Today, it's rather easy for portfolio managers to screen for securities that satisfy certain criteria. You know, you used to be able to buy companies for less than the cash in the till. We called that net investing. You can't do that anymore. And so, over time, knowledge is cumulative. Markets become more efficient. It has become harder to beat markets. Still, I believe some people can be superior. Their margin of superiority may shrink. Their workday may get longer. But I still think it's possible, but it becomes harder every day.
Yeah, I think, again, it depends on the nature. Like, even when you describe it 50 years ago, people could, but most people didn't, right? Like, even like at some point, having a calculator was an advantage, and obviously having a calculator is no longer an advantage. But I look at it a little differently. I think it's like the Indy 500 or whatever. The cars get better every year, so you have to get better every year, but there's still a winner. And so if you stay, if you don't get better, then for sure, any advantage will seep into general understanding. But if you continue to get better, it is like the Indy 500. And the core, at least the core things that I believe our alpha is generated from, really aren't changing much. I don't think we're getting any better as a species on things like love and fear and greed. Like, we keep doing the same things more or less over and over again. So I agree on things like calculating and arbitrage. That is like much easier to do. It's generally well known. Those things are not there anymore. But the fact that people are going to make, we all will, make really dumb mistakes, and if you have ways of understanding that and doing that, that continues. And I really, when I look at the markets and the volatility of the prices relative to the fundamental conditions and whatever, it doesn't look like we're getting that much smarter. It's true on arbitrages are going away. I think that is the case. Things that you can calculate are going away. Things that are very hard to calculate seem as volatile as ever, and the miscalculations of human beings continue. So I don't know that, again, I would agree, if it's an established arbitrage, it will not exist for, like, it'll get learned, but other things continue more or less as they have through all human history, it appears to me.
Are there still more inefficiencies in private markets to be explored relative to public, and for how long?
I think private markets were, 40 years now into institutionalization of private markets, and for sure private equity. I think that there, is a whole class of investing that goes on in my world where we buy from each other's portfolios because, like, why do you rob a bank? Because that's where the money is. So many assets are owned in private hands. So I look at Christian, we bought a business from you. Nick Humphreys is here from HG. We bought businesses from them. And what's really interesting is the return profile of buying things in the private markets, even from professional owners like sponsors, is really the same as it would be for a primary buyout. And so you sort of sit there and you ask yourself why, and I think it's a whole bunch of factors, including having a differentiated point of view, which Howard spoke about. It's having professionally trained management teams that really know what they're doing in terms of businesses. So I actually think right now there's a lot of inefficiencies in the public markets. I think there's a ton of really good businesses, but crummy stocks. 25% of the public markets are 50% or below their highs. So, in terms of my shopping list, I'm spending a little bit more time at the public markets right now because I think you get much more volatility in the public markets than you do in the private markets. Because when you're private, and if you don't have to sell, you don't sell.
Changing tack a bit, Greg talked about the power of compounding learning. Things may not always pan out the way that we think that they will. How do you institutionalize learning from mistakes in your organization?
So we do a number of things. Some short term. We have a daily meeting every day, and in that daily meeting, which happens in our London office between Asia and London, and between Boston and our U.S. offices in London every day, we talk about all kinds of things, and including sometimes we talk about if something's happening in the market. What did you learn from the last time the market was like that, and what mistakes did you learn? So we do that. That's sort of a constant. And back to like having different perspectives. there will be people that will come to our daily meeting and said, I got this wrong, and this is what I learned. So we've normalized sort of not being a star and not being right all the time, which is, as we know, being an investor, you're wrong quite often. So those are some of the things we do. And then we also do these things called lessons learned. So we would have someone who's been investing for 25 years or 30 years, and we ask them to be vulnerable. What really was the reason and the seminal moments in your investing career? And it's really about investing, these talks. Who they are as a person, what do they believe, and how are they investing? What are the 4 or 5 guideposts that sort of made their career, and those are all recorded, and people watch them and learn from them, and it gives you a good appreciation of just that people are human beings. We try to, we don't have a star culture, and the more people are willing to teach others and teach themselves, and as we know, you haven't learned everything. Like, I'm in my mid-50s, I've been investing for 33 years, I'm still learning. And so how do you make sure that that's part of the everyday language? So those are some of the sort of the things we do constantly over time that sort of normalizes the fact that you're making mistakes all the time.
Good. Howard, any views on the institutionalization of mistakes?
We don't have a process for that. Your question suggests to me maybe that we should, and maybe
that's why I'm curious.
And maybe we will. But we have groups, as Jean says, and a high degree of independence. We're decentralized in our decision-making process, as long as, in our case, everybody follows the same philosophy and goal system. But we don't have a process for postmortems, and I think it's a good way to learn.
It's so critical to our philosophy, and to be clear, it's very hard, because the thing that she's talking about was so important, which is the last thing you want to do is punish mistakes. You have to help people learn, and so we've struggled with the right institutionalization, but I've been institutionalizing this for a long time. So just to share quickly thoughts on it, I mean, the first thing I would say, if I were in anybody's organization that doesn't, like, having a real issue log is so valuable, and it actually works. Like, for us, it's very easy for people to enter issues. And again, when you think through what are the issues that matter, everybody's got issues, but the issues that matter to us are the things that are preventing you from achieving your goals. And so, to me, then having a diagnosis process that we let people, make it easy for people to enter and make it easy for people, like, to diagnose what's happening. There's 2 levels of that. There's the level of, like, in the org problems, but then you have this record you actually diagnose and decide, are you going to change anything as a result of this, right? It's easy to talk about problems, but are you actually changing anything? And oftentimes the right answer is, I'm not changing anything. Mistakes are a normal part of it, but knowing whether actively deciding, are we going to change something or are we not going to change something? Super important. So having a simple way for people to do that and see that it's actually happening is super important. Encouraging it mostly. Most important is that the most senior leaders, the CEO, the CIO, they're the ones getting issue logged, and they're the ones staring because they make the biggest, most important decisions. So making sure the arrow of accountability goes up, not down. Super critical lesson in our org. I think we had a lot of the arrow going down, and it was a big mistake. Encouraging the arrow of accountability to go up was a huge lesson in our organization. I'd change everything, I honestly believe. And then on the investment process, I mean, one of the great things back to systematic investing is we know on attribution every mistake, down to every data series, every little piece of logic, every data series, we know exactly why we got everything wrong. Like, speaking to his point about terrible macro investing, right? Like, I really thought we were going into a recession 2 years ago or so, and man, was I wrong, right? But okay, we learned something about the world that we didn't know. And by being able to attribute that to every line of reasoning, everything that we had ever learned, that led us to that pretty strong conclusion, not so strong that was disastrous in the way he's saying, but pretty strong conclusion, knowing that we could easily be wrong, but but being able to attribute that to everything else, and then attribute, well, where did the money come from that prevented that recession? Attribute every one of those things, and what do you learn from that? Super, super critical thing to get right. And I would just say the thing I think everybody can do, and I would highly recommend, is have an issue log, diagnose important issues, get in the habit of it, and normalize it. It'll make the organization so much better.
Excellent. One last topic before we wrap up, specialization. So when investing, what are the trade-offs between specializing too much and missing the big picture?
Well, I used to have a yellowed clipping above my desk 50 years ago, orange, so it came from the FT. And it said that an analyst is somebody who knows a lot about a few things and learns more and more about less and less until he knows everything about nothing. A portfolio manager is somebody who knows a little bit about a lot of things and learns less and less about more and more until he knows nothing about everything. We have to bridge that gap. We have to know that there's information in our organization that some people have and other people need, and we have to get it to them. And the people who need it have to know that it exists and where. This is one of the greatest challenges in any organization. Greg described the way all of their learnings and findings are actually computerizable and computerized and shared. And I think it's a good idea. But you know, how will the portfolio manager who has to put together a large number of assets about which he knows less ever get full advantage of the knowledge that the analysts who know so much about a few things have? And you know, we struggle with it all the time. There's no easy answer.
Very good. We could go on forever, but we must finish now. We will take a break now. Refreshments will be served at the back in the canteen. For those of you watching live somewhere there, we will be back in the room at 1:45 p.m. Sorry. But before closing, let me thank you all for spending the time with us in Oslo today. It was an immense pleasure to have the four of you in this panel. Please join me for a round of applause.
Investment management is about taking risk. And quite frankly, that's what makes it so much fun. But risks, that means things can go wrong. And from time to time they do. And when the big ones happen, man, it can feel like a gut punch. It really can. The thing is that in this game, we know that this can and will happen. It's just the way it works structurally. But that just does not prepare you for your reaction when it actually does take place. And that reaction is so important. And the different dimensions to that reaction, like what's your reaction as an individual? What's the reaction of your colleagues? Incredibly importantly, what's the reaction of management? How that all fits together, that really determines how we deal with adversity and challenges going forward. Talking about psychological safety when everything's going smoothly, it's super easy. But it's when you're out there in the really rough water, that's when you as an individual and we as an organization are really tested.
Mistake. An easy word to say, but a difficult one to admit. This is why it's important that investors are in an environment where they can fail and try again. Our first speaker for our session on successful investment organizations is Amy Edmondson. She is a professor from the Harvard Business School and has dedicated her entire career to understanding the many benefits of psychological safety. Today, she'll be having a conversation with Anders Meland from NBIM, a sports psychologist who helps our portfolio managers make more money. So please welcome Amy online and Anders on stage.
Now, I can't quite hear you.
Conversation.
There.
You can hear me now?
Now I can, yeah.
All right.
And
but here it's super safe, so no problem.
was
Okay.
great. I loved it. I loved the opening. I loved the video.
Yeah, same here. We have fantastic people here. And yeah, it takes a toll on them once in a while, you know.
Yeah.
So psychological safety, why do we need it as investors? And what does it look like?
Well, I think you need psychological safety as investors because your success depends on your ability to make high-quality bets. Now, you might not like the word bets. You might prefer decisions or investments, but make no mistake, they're bets. Right? There's uncertainty in that way. And those are absolutely dependent on high-quality conversations. And high-quality conversations are dependent on psychological safety. They require that people lean in and say the uncomfortable truths. When they raise an idea, they raise a concern, they raise a dissenting view, and the conversation includes sort of questions and answers and makes thoughtful progress toward an uncertain resolution, right? But one that people feel is high enough quality to go forward, right? So what does it look like? It looks like a sense of permission for candor. It does not look comfortable. You know, in fact, it probably looks a little uncomfortable because it's not natural and normal to lean in with the thoughts you have that you're not absolutely sure are right or helpful.
Yeah, so the obvious question is also when it becomes kind of unsafe, it becomes unsafe once in a while, anytime. But when it becomes like chronically unsafe, what do we do? Any advice to the audience there?
Yeah, I mean, because when it becomes chronically unsafe, what you end up with, which by the way is invisible, and I think it's really important, you know, to recognize the asymmetry here, because you can hear when people speak up, you cannot hear when they hold back. You just don't know that there actually is something in their heads that they're not sharing. So in a sense, as a leader, you have to assume that it may be happening and that it may put you at risk and the quality of the work at risk. So I think what the place to start is just, and it may seem, you know, old or redundant, but keep reminding people of the nature of the work you're doing, that the work you're doing necessarily includes uncertainty, right? It necessarily benefits from diverse perspectives or backgrounds that, you know, that have a different angle on the situation. And so why does that matter? Because when you are reminding people of the uncertainty and what's at stake, you're setting a kind of intellectual rationale for why it actually makes sense that you do care about their voice.
So you actually focus on the why we need it. So the drivers, not so talking too much about psychological safety might actually backfire a bit.
No. In fact, in some ways, if I had my druthers, I'd recommend don't talk about it at all. Just talk about what does a high quality conversation look like? How does it include people, you know, really taking those risks to share their thoughts and being willing to listen intently in the moments when they're not speaking, right? So that together we are making progress toward the best possible decision we can make.
All right, so this psychological safety goes a bit up and down, so it fluctuates a bit. But how vulnerable is it really from your perspective? Maybe that's a bit too global question.
Yeah, I mean, this is sort of the problem, is that it's actually quite vulnerable. And I think there's two asymmetries that people need to internalize and sort of intellectually and maybe emotionally as well. And one is what I call the risk-reward calculus, right? And that's imagine a moment where you are weighing, maybe not entirely consciously, but you're weighing whether or not to speak up about something, to share a thought, a view. And in that moment, if you were to speak, who gains? Well, the team, you know, the organization, if you will. How confident are you that your voice will produce a gain? Not very. And when will that gain occur? Well, sometime down the road. Now, if you, because you're not quite sure, stay silent, who gains? You do, right? You stay safe and comfortable for another minute. When does that gain happen? Immediately. How confident are you that your silence won't produce a bad outcome? 100%. So that's a pretty profound asymmetry. When you think about it, you realize that leaders actually have to go on a treasure hunt, because otherwise the risk reward calculus will get you every time. And I think the other is the asymmetry between the good and bad exchanges, right? So if I have and maybe it happens rarely, but if I have a bad reaction to my taking a risk and speaking up, and someone is dismissive or judgmental, or even downright humiliates me, I will not try again for quite some time. Whereas if I have a good response, it won't sort of preclude me from trying again, but it doesn't necessarily make it that much easier. It just doesn't make it harder, right? So again, the degree to which I'm willing to try again goes vastly down if I have, one humiliating moment. And so given those sort of asymmetries, you have to sort of, I guess I'm just answering your question wholeheartedly, which is you are vulnerable.
Yeah, makes sense. I think we all can relate to that as well. So one misunderstanding or what we ended up realizing sometimes is that people, when we talk a bit about psychological safety, we have to open the box a bit and then we talk about it. And then people maybe miss the point. So they're trying to make it comfortable, but for no particular reason, performance-wise. So you get points for making it safe, but you forget to draw the link between that. What's your advice for those misunderstandings?
Yeah, I mean, I think my advice is to come to that constant sort of appreciation of the knowledge-intensive, really intellectual work that you do, and that's different from, say, high-risk work in a power plant or an aluminum plant or something like that. But there are some ways in which you have it in common, which is that both require a sense of vigilance, of very thoughtful, conscious interrelationships with others. I'm interrelating, meaning I want to listen to you closely. I want you to listen to me closely. We want people to be paying attention. And it doesn't mean you have to be, completely on all the time. There are breaks, of course, and we want people to, leave at the end of the day, go for a run, whatever works for you. But that sense of awareness that the knowledge-intensive and intellectual work you do requires a kind of alertness and an engagement to do it well. And what allows people in high-risk industries to perform well and to avoid sort of catastrophic accidents or worker accidents is not a kind of a blind spot about failure, but quite the opposite. It's like almost a preoccupation with failure. They are aware, that around every corner is a potentially fatal accident. And because of that, they sort of bring their A game to the moments that need it. And all I'm suggesting is you can bring your A game to the moments that need it. And it requires vigilance. It requires a little bravery. It requires just kind of an appreciation for what's at stake.
All right, thanks for sharing that. Isn't it interesting? Us nerding about, on the psychological safety part. So guess what? Yeah. Amy has written this great book. I just finished it. The Right Kind of Wrongs is the name. It's a book about failures. Way great fun.
What fun!
So you separate. So I think sometimes having a language around failures and doing things wrong is like digging or have some more precision to it. And you have an interesting separation between basic, complex, and intelligent failures. Can you clarify a bit? Sure.
So a basic failure is a failure that occurs in familiar territory, usually because of human error. Just a single dumb mistake leads to a basic failure. For instance, in 2021, a Citibank employee accidentally checked the wrong box in an online form and accidentally transferred $900 million to a group of lenders, right? Oh. And then later, a judge made a controversial ruling that did not allow Citibank to reclaim those funds. Right? So that was a single human error, maybe not paying attention, maybe not well trained, I don't know, that led to a failure that we would all consider fairly sizable, that was nonetheless basic. So basic doesn't mean small or big. You know, it's a basic failure when you forget to charge your phone and, you know, miss a meeting, whatever. But some of them are big, some of them are small. Basic. Complex failures are ones with the perfect storms. They're the failures that inevitably happen in, you know, relatively familiar territory when a handful of small deviations from best practice come together in just the wrong way to create a failure. A supply chain breakdown in a global pandemic, for instance. Again, basic failures can be, complex failures can be small or large, but what's different is that any one of those factors on its own, those small deviations, wouldn't produce a failure. It was the perfect storm, the way they came together. Neither basic nor complex failures are worthy of celebration. Right? They're not useful. Like when we're at our best, we can prevent them. I mean, some of them will slip through. I understand that. And that's okay. We're human. But when we're at our best, we don't need to have those. They bring us learning, but not a whole lot of new learning. In contrast, what I call intelligent failures are those that explicitly occur in new territory. They are the undesired results of thoughtful experiments. So for a failure to be intelligent, we must not yet have the knowledge we need to get the result we want. So it's new territory. Much of your work is in new territory by definition. Yeah. It's in pursuit of a goal, whether that's making money or, you know, mastering a skill or making a scientific discovery. You have a goal. Number 3, it is hypothesis driven. You've taken the time to figure out what we know, what we don't know, and you've made a good bet. And then finally, for a failure to be intelligent, it should not be any larger than necessary to get the new knowledge. Right? So this is what scientists do every day. But I would argue in your business, you are doing this as well. Athletes also do this.
Yeah,
right?
I think
they're
we do.
You're trying to get into new territory. You're stretching, and it doesn't always work.
Yeah. So new territory, we need to take risk, and we should celebrate it. Because we don't know.
And then,
it's hard to.
Yeah. You have to train yourself to say, okay, that was disappointing, and it's still valuable. Right? Yeah. It brings us something we did not know before.
Yeah, and old territory. So we're all human beings. We had some errors, small, today. You know, things happen. We should get them out in the open so we can identify them, learn from them, and maybe, who knows, we might even prevent them next time. But
yes, exactly.
Yeah. So that's useful. Just before we run out of time here, Amy. So we see that in this marathon sport, you become world champions of committing mistakes or doing something wrong, and so you want to focus on the wins, right? But I can see it takes a toll on quite a few people. Any advice? I suppose this is my job, but any advice?
Yeah.
How can people travel light but still remain their heart? Because we're long term. We want people to last. Be 150 years.
It's, you know, part of it is having a more, you know, training yourself to have a more rational response to the disappointments. I mean, I think we have a natural response that's quite emotional, and we believe, you know, at some level we believe, well, that shouldn't have happened, and it exhausts us in a way to think that way. And when we learn to master the pause, you know, just insert that space between the stimulus and our response, we can then think more rationally about the situation. Okay, that's disappointing, and what do we learn from it? What actually happened, and how do we use it to go forward? It's almost a relentless forward focus. We care about the past because the past is full of learnings, but our focus is on the future. And what do we do with all that valuable learning?
That's good advice. I just have an afterburner. I need to ask you, Amy. This psychological safety really strikes the chord. Researchers, applied practitioners, organizations have used it to become better. Where are the herds going in social sciences now, do you think?
You know, I don't really know. It seems to me all anyone can talk about is AI. So maybe it's AI nudges that help us master the pause, that help us, you know, sort of be brave, be more rational. I don't know, but we'll have to just wait and see.
This was great, Amy. Thanks for joining us. Bye.
Thanks for having me. Thank you.
Thank you so much, Amy and Anders, for that really interesting conversation. We are continuing on the topic of what makes a great investment organization, and we will now hear from Robert Wallace of the Stanford Management Company, where he oversees the university's endowment portfolio of roughly $40 billion. Now, Rob is no ordinary investor. Indeed, before his career in investment management, he was a professional ballet dancer with the Boston Ballet, the Washington Ballet, and the American Ballet Theater. Now, I'm not sure if Rob is going to talk about what the performing arts could have taught us in building successful investment management organization, but we are certainly looking forward to hearing you. Thank you.
Thank you very much for that very kind, too kind introduction, Trond. It's very nice to be with you today, and I'm going to share with you a framework that I often use at Stanford University when I think about managing the Stanford Endowment. And it really focuses on three things that we have to do right, we have to do well if we want to be successful in the long run for Stanford. I call them the three pillars of investment success. They are strategy, execution, and governance. So I'm going to talk about each one of those briefly, and then I'll finish with sharing some of our long-term investment results with you. But before I start, just to orient ourselves, maybe I'll mention a couple high-level facts about Stanford. So Stanford University is a research university located in Palo Alto, California, about 1 hour south of San Francisco, in the middle of what's sometimes referred to as Silicon Valley. In fact, the technology ecosystem that is Silicon Valley really built itself around Stanford over the last 50 or 60 years, and important companies like Google were actually started on the Stanford campus. The university was founded in the late 1800s, and unusually at the time, it was founded as a co-educational school. So the very first class that matriculated at Stanford had both men and women in it. Today, there's 7,000 undergraduates at Stanford, 10,000 graduate students, and 2,300 faculty members. The endowment, as Trond just mentioned, is about $40 billion, and this year it will distribute to the operating budget of the university $2 billion. So that is the single largest line item in Stanford's $9 billion operating budget. So that brings me to the first thing that you need to do right if you want to be a successful long-term investor, and that's strategy. And here's a quote from the great Norwegian polar explorer Edmondson: "Victory awaits him who has everything in order. People call it luck." What a nice, succinct way to talk about strategy. You have a goal, you need to build a plan, a strategy to achieve your goal. We have two key goals for the Stanford Endowment. One, we want to be able to be a material part of the life, the academic life of the current generation of students and scholars at Stanford. So I mentioned roughly $2 billion flowing from the endowment this year. It's about 5% of the value of the endowment. That's goal number one. Goal number two is we want to be at least as impactful and supportive for all future generations of students and scholars at Stanford. So that introduces a concept that we call the preservation of purchasing power. So that just means that if you're spending 5% every year from your endowment, you have to earn back at least that 5%, but you'll also have to earn enough to offset the impacts of inflation. The inflation that we care about at Stanford is higher education price inflation, which tends to run a little bit higher than consumer price inflation. So if CPI runs at 2 to 3% over 40 or 50 years, higher education price inflation is going to run at 3 to 4%. So when you put 5% of payout together with 4% inflation, you have a pretty high, you need to have a pretty high expected return to offset your spending and still preserve the purchasing power of the endowment. So the way that we do that is we have an equity bias in the portfolio. Equities have a higher expected return than fixed income or cash, and that's really important in the long run if you want to achieve that second goal. Unfortunately, as we all know, equities are very risky. You rank the lowest in priority in the capital structure. It's much more possible to lose your capital and have a capital impairment. Equities are also very price volatile. Volatility is not the only risk that you care about. It's not even, maybe not even the main risk, but it is a risk. And the reason that it is a risk is because unnecessary or extra volatility that you're not being paid for will erode your long-term compound return. So to make this clear with a simple example, if you start with $100 and you have a 50% return in year 2 and a negative 50% return, 50% return in year 1 and a negative 50% return in year 2, where do you end up? Well, at the end of year 1, your $100 has become $150, and then in year 2, you lose 50%, it becomes 75. So you're up 50, down 50, but you've just lost 25% of your money. So volatility erodes long-term compound returns. You can see that with the identity shown on the bottom of the slide. Whenever volatility is greater than 0, your geometric or your compound return will be lower than your single period expected arithmetic return. So how do we deal with that extra risk? We diversify. We look for something that Nobel laureate Harry Markowitz called the free lunch. So we own different types of equities. We own some equities in the United States, some equities in Europe, some equities in Asia, some that are purely corporate, so think of venture capital, some that are backed by physical assets, so think of real estate. And when we put those equities together, they are positively correlated with each other, but they're not perfectly correlated. So they react somewhat differently to different macroeconomic states of the world. So we're starting to gain some stability through that diversification. Then we introduced 2 other asset classes, fixed income and absolute return, which is a collection of carefully chosen relative value strategies from the hedge fund world. And we put them together with the equity asset classes in our portfolio. We end up with a portfolio designed to give us a pretty high expected return, but with low levels of volatility or reasonable levels of volatility. This is our policy asset allocation at Stanford right now. So this is the most succinct way that I can explain our strategy. Down the left-hand side, you can see all the major asset classes as we define them. On the right, you can see their policy target weights. And everything on this slide is an equity-oriented asset class, except for those 2 middle asset classes, absolute return and fixed income. If you do the quick math, you can see that the equity asset classes add up to about 70% of the portfolio. So here you can see we're designing a strategy to achieve our goal. This is an equity-oriented portfolio, yet it has substantial levels of diversification. When we model this portfolio, it gives us an expected single period return of 8.3%, so that's deflated by higher education price inflation, expected volatility of 15% on an annual basis, and that leads to a compound return expectation of 7.1% net of inflation. So if this is true, if we specified the portfolio correctly and we achieve a 7% real return, we can pay out 5% a year, or even a little bit more, and still preserve the purchasing power of the endowment for future generations. The next key pillar that we have to get right is execution. And this is one of my favorite quotes from the American inventor Thomas Edison. Opportunity is missed by most people because it comes dressed in overalls and looks like work. And, and this really is what we do most days at Stanford Management Company. We execute against the strategy that I just showed you. So execution has a couple parts. The first is portfolio management. So every day we get a flash estimate of where the portfolio is. It comes out about 7:30 a.m. And we may start to make one of 2 types of actions. The first is we may rebalance the portfolio between asset classes. So as market movements take those asset classes away from their policy weights, the risk return and liquidity characteristics of the portfolio start to shift from what we think is ideal. So we will normally sell what's gone up in value and bring it back down to target, and we'll buy what's gone down in value and bring it back up to target. And that way we preserve the right risk return for the portfolio going forward. So that's rebalancing. Sometimes we rebalance once a week or once every 2 weeks. In volatile capital market environments, we may rebalance every day. The second type of portfolio management that we conduct is rotating capital inside of asset classes. So I should take a moment and explain that the security level decisions for the Stanford Endowment are made by external partners that we find, we identify, we try to build long-term relationships. These are very specialist partners, very, very good at what they do, whether it's stock picking or venture capital or private real estate. It's very hard to find these partners, and I'll talk about that in a minute. But once we have found them, we have a strong, trustful communication, and when their opportunity set evolves, we can take some action to optimize Stanford's capital. So if their opportunity set gets more attractive, we can give them more money. If it gets a little bit less attractive, we can take some money back. So we're always doing that. The combination of rebalancing between asset classes and rotating capital within an asset class can sometimes take up 30, 40, or even 50% of the value of the endowment in a single year. So we're very active in managing the portfolio. So I mentioned external partners. This is a really critical part of execution and a huge part of what we spend time on at Stanford Management Company. These are, generally speaking, pretty small, niche, boutique investment firms that we find. They're very principally oriented. You probably wouldn't know the names of most of them. And I'll tell you what we look for when we go looking for new partners. First of all, we want to see discipline. We want to see partners that understand the difference between investment and speculation. Understand that some things can be analyzed with a high degree of rigor, and some things can't be. And we want them to focus their investment work on the former and not the latter. We want them to have a strong, thorough, and repeatable process, something that we can see and feel and touch, that surfaces all the hard and soft variables that they need to think about in any given situation. And then finally, we want them to take all that data and apply superior investment judgment. That's the hardest part for us to suss out when we're meeting with a new partner. Really, how do they assess risk and return? What kind of weights do they put on the various parts of their investment thesis? And usually when we make a mistake about a partner, it's usually that we get their investment judgment wrong. We like it when our partners have the appropriate amount of capital. So investment success often leads people to have too much capital. They kind of outgrow their competitive sweet spot. It's very common. We like it when that happens, that our partners return capital to us. And so it's really important that size doesn't become the enemy of performance in our portfolio. And finally, we try to structure a strong economic alignment of interest with our partners. So are we compensating them appropriately over the right time horizon, over the right cost of capital? Are they putting their money alongside us so that we're eating the same cooking? Do they do well when they do well for Stanford? These are all important parts of what makes a successful long-term relationship. I should also mention at Stanford that we believe long-term investment success requires an appropriate regard for human and environmental welfare. So we insist that our partners have that same philosophy. That philosophical alignment of interest is just as important as the economic. This slide sort of gives you some data on why partner selection or security selection is so important. We're looking at leveraged buyout funds from the United States formed between 2001 and 2020. So these are reasonably mature buyout funds. The top dotted line is the top 5th percentile buyout result for that year. The bottom line is the bottom 5th percentile, and the median is shown in the solid line in the middle. So one thing immediately jumps out from the slide. If you're in the top of the distribution, if you're in the top 5th percentile of the leveraged buyout universe in the United States, you're outperforming the median by around 20 points per year. These are net annual IRRs, so 20 points per year on a closed-end fund that's 10 or 12 years in life is a lot of money at the end of the day. So that's an incredible outcome if you can be in the top of the distribution. The second thing that jumps off the slide is, look at how bad you do if you're in the bottom of the distribution. If you're in the bottom 5th percentile, you're underperforming the median by 20 points per year. You're almost certainly ending up with a result that's below the public markets that you could access for, very easily for low cost. So this slide really is why execution is so important. If you have a complex strategy like Stanford, you have to feel certain that you can be in the top of the distribution in this type of asset class. I could show you similar slides for venture capital. It would be even more dramatic. Private real estate, absolute return strategies, all of them show this type of dispersion, which means that you really need to execute well if you have the type of strategy that Stanford has. How do you execute well? Well, you have to have the right team. So we hire people that are very intellectually curious. We heard about this from some of the early speakers, people that really want to continually grow as investors, that seek and accept a high degree of personal accountability for their work. So I often tell our analysts at Stanford Management Company, you are the Stanford endowment. I really want them to internalize their work for Stanford. It helps that they're motivated by Stanford's academic mission. This is, it's hard work, and so having some psychological benefit, knowing that you're doing something that is very valuable for the world, is really important for the team. We also try to grow our own talent, so we're often hiring right out of Stanford undergraduate and training our own investment professionals. In fact, I'm joined today by my colleague Thea Rosenberg, who's an analyst in our office. Thea was born and raised in Oslo. She went to Stanford undergraduate, and while she was an undergraduate there, she took our class in economics that we teach once a year, and she became an intern in our office. After she got her master's degree, she joined us full-time, and so Thea is a great example of someone who's intellectually curious, seeks and accepts a high degree of personal accountability, and is very motivated by Stanford's mission. We're delighted to have her on the team. You take the right people and you put them in the right culture. So we have a very open, collaborative culture. I like to think we're all in the same rowboat pulling towards the same shore. We all sit on the same open floor plan. We try to reduce bureaucracy. We try to minimize hierarchy. That's a lot better for communication. It's a lot better for training your junior professionals. And it's also a lot more fun, and having fun is a really important part of long-term success. So the final pillar of investment success is governance. And this one is talked about less, but it's just as important. Here's a great quote from another incredibly impressive Norwegian polar explorer, Nansen. The difficult is what takes a little time. The impossible is what takes a little longer. And this is a great quote about governance. So governance, just as important as the other two pillars, and good governance supports the disciplined execution of the right strategy. And this is really critically important, particularly in times of market extremes. So you can think of a time of extreme euphoria where there's some hot sector, some hot asset class of the day that's dramatically outperforming everything else. And by definition, your diversified portfolio will underperform that hot sector. And bad governance would say, chase that sector. Always go with it, try to catch up with what's performing well. That's unlikely to work out well over time, and certainly would entail taking a lot of risk. The other type of extreme is fear and panic. So think of the fall of 2008, when everybody was selling every risky asset and trying to raise cash. The right thing to do in that environment, if you were an institutional investor, was to buy the things that people were selling, buy the things that had fallen 40%, 50%, 60%, and sell the other stuff to rebalance your portfolio, to bring the desired risk and return back to the portfolio on a go-forward basis. So governance reinforces the disciplined execution of the right strategy and shelters the management team from external influences that might make that very hard. Okay, so just to finish on this one, this is our long-term investment results. So if you had taken, so Stanford Management Company was formed in 1991 to professionally manage the endowment. If you had taken $100 in 1991 and invested it in the endowment portfolio, you would have made 32 times your money by the middle of last year. That's roughly double the result that you would have achieved in the typical US endowment fund, and roughly 4 times the result that you would have achieved had you taken that same $100 and invested it in a 70-30 portfolio, 70% global equities, 30% high-quality bonds. So if you form the right strategy, if you specify the right strategy based on the goals that matter to you, if you have the ability to execute on that strategy, and then you have good governance that protects you from outside interference, you can get attractive long-term investment results. Thank you very much.
Thanks so much, Robert. We really enjoyed hearing from you. Now that we've heard a little bit about what makes successful investment organizations, it's time to shift our focus to those that make these organizations successful, the investors. What elements of psychology go on to making better investors? What do investors have in common? with professional athletes. Let's see what our team performance coach from NBIM, Björn Mansberg, has to say.
I don't believe in miracles, even though they sometimes happen. Great performance comes from working hard, doing the right things, and stop doing the wrong ones. Sounds easy, right? Through my whole life, I've been working with performance cultures. As a fighter pilot in the Air Force, with the best football team in Norway, and with some of the best financial investors in the world. So what is the common denominator for high performers? It is the way we as individuals keep on strengthening and regulating our capacity, always striving to learn, develop our skill sets, and maintain a conscious focus. It is also the way we interact with others, sharing lessons learned, giving feedback, exploiting our diversity, and taking risk together. Bottom line, it is your ability to do what's right for you and your team. A sustainable high-performance organization is not a miracle. It is hard, conscious work, teamwork.
So in person, here today, we are so lucky to have Marc Rowan, the co-founder and current CEO of Apollo Global Management. Now, not only is Marc a highly successful investor, he is also a well-known philanthropist, supporting initiatives on projects within education, art, and healthcare. So please welcome Marc Rowan to the stage.
Thank you. And what amazing advice we have all been the beneficiaries of, not just most recently from Adam, but this morning. I thought I'd come at this my own way. And when I tell my organization, don't be defensive, be curious. Change is a constant. We, as investors, we in financial services, I think have consistently underestimated the impact of change. We've been resistant to change. We've denied change. We stick to the status quo. And I thought I'd just maybe share some examples of change and how impactful it is. So this is now my 40th year doing this. And I tell my team, I look back over 40 years, and when I started, no high yield bonds, no levered loans, no ETFs, minimal securitized product. Now those 4 products are incredibly dominant in our financial landscape. Why do we think they're going to be here in 5 or 10 years? Why do we build investment strategies on them? Are the circumstances that allowed them to essentially take hold still the circumstances today? I don't know. I look back, again, over 40 years, and I think we've lived in a period of tailwinds. For my career, I think I've been very fortunate. I think most of you have been very fortunate. We've had 4 tailwinds. Rates have gone from high to low. We have printed an awful lot of money. We have borrowed forward future demand through fiscal borrowing almost everywhere in the world, and we've had the benefit of globalization. Are any of those 4 things true going forward? I don't know. I think there's a healthy debate as to whether they are headwinds, but I would argue I think we're in the absence of tailwinds. Why would we think the investment strategies that work for the past 40 years would work going forward? Is there actually any value to track record over the last 10 years? Or should we just completely throw it away? We all, as investors, take great comfort in looking at the last 5 years, the last 10 years. What are the chances that we're going to print in the US another $8 trillion and everything will go up to the right? Why would track record be relevant? You know, I think a healthy skepticism. You were, in 2019, the best investor in the world. You left Norway and you moved to Austin, Texas. And all you bought in Austin, Texas was multifamily. And you bought multifamily in all the right locations, and your buildings are now 100% occupied. Your rents have been growing 10% a year. You took out your 60% mortgage at 3.5%. You were feeling great. You were the best investor in the world. What's your equity worth today? It's a math problem. Rents up, cap rates up, your equity's worth 50 cents on the dollar. Were you a good investor? Well, in 19, you were a really good investor. In 20, you were a good investor. In 21, people were not so sure. In 22, you went to the bottom of the bottom. And in 23, people are pretty convinced you were lucky, not smart. Maybe we should use the words enterprise software instead of Austin, Texas. Maybe we've been living in tailwinds, and we have to learn to accept change. I know in my organization, a lot of the things that Adam just said, we do. There's active encouragement of intellectual insubordination, which I distinguish from outright insubordination, because that makes it difficult to run the business. But there is no hierarchy for a good idea. There is no ability to feel uncomfortable. This is something we actively promote. I gathered my partners in Abu Dhabi in January. Every couple of years we get together and we talk about the future. And I started with Apollo in 2008. Apollo in 2008 was 40 billion of AUM. Apollo in 2023 was 650 billion of AUM. We grew 14 times. We outgrew Apple. We outgrew Microsoft. I think we outgrew everyone other than NVIDIA. By the way, all organic. Next question. Were we lucky or smart? Come on, you guys know this. We were lucky. You can't possibly expect to grow a financial services business at 14 times. We were smart only in that we were in the right place to prepare for change. And change happened. Think about the trends that drove us from 40 billion of AUM to 650 billion of AUM. Financial crisis in 2008 weakened most financial institutions. They were playing defense. Rates going to zero pushed investors who had made promises to retirees to look for alternatives. Those are the factors that drove our growth. And so sitting in the beginning of 2024, I'm looking out and I'm saying to myself, where's change coming from? How do we first accept that the success that we've had is based on a series of things that no longer exist? How do we prepare the organization to accept change? What happens if we're wrong? I think I'm wrong at least 40% of the time, which would make me, in baseball terms, the most productive player ever. Well, let's create an organizational culture that accepts that you can fail and fix your mistakes quickly. Let's not fire people for making bad decisions. Let's fire them for making no decision. And that's, I think, what we've done. So I sit out and I think about what the team said this morning, what you heard from Wellington, what you heard from Hellman and Friedman, what you heard from Oaktree, and I think all of it is true. And I'm going to add my gloss on top of it. I think we as investors are not mindful enough of the massive change taking place, and I think some of the change is predictable. So I'll give you how we are building our business based on change, on things that we observe. 2008, we nearly destroyed the worldwide financial system. We implemented massive amounts of change. None of us, me included, have yet to experience any of that change. Because right after we changed the rules, we printed $8 trillion and everything went up and to the right. We've now had about 18 months of living with change. So what could we observe? Easy one. Are public markets liquid? I don't think so. Maybe on the equity side, that's true. On the fixed income side, no. 2008 put an extreme penalty on market-making capital, in fixed income in particular. Market-making capital is 10% of what it was today, of what it was in 2008. Markets are 3 times their size. Yes, we are living with 1/30 of the liquidity. It now takes 5 days to sell an investment-grade corporate bond outside the top 20. We've actually witnessed wholesale market failure. this cute little thing called LDI in the UK. This was not some crazy thing UK institutions were doing. This was a mistaken belief that they could sell AAA and AA obligations at or near the market price. They were wrong. They started selling, the price collapsed. Bank of England ultimately had to step in. Should we actually think on a go-forward basis that this is the norm, that liquidity only exists on the way up, it does not exist on the way down? Why do we want to be public? Why do we actually distinguish between public and private? What is actually the difference between public and private? It's not clear to me that there's any liquidity difference, equities aside. Second big fundamental change. 2008, most of the regulation around the world, not just then, but continuing to today, has to reduce the role of banks in the economy. Everywhere in the world is going through debanking at different rates. In the US, banks today are less than 30% of debt capital. Investors are the other percentage. Every regulator, every government, everywhere in the world has two choices. Capital can come from banks, or capital can come from investors. There's no third choice. Once you choose investors, you have two more choices. They can come from the daily liquid public markets, or they can come from institutional private markets. Think about the priorities, particularly in Europe. Energy transition, climate change, infrastructure. Everything I just mentioned is long-term. Why would we want that funded on a daily liquid basis? Wouldn't we want that funded in institutional markets to match liquidity? Where is systemic risk? Think about why banking is being disfavored. Banking is being disfavored in part because banks borrow short and lend long. Do we really want more borrow short, lend long by using more public markets, or do we want private markets? This whole rethink of the role of a bank, the role of an investor, is a massive change. We as investors are going to experience products in the in the fixed income space that we've never seen before. Risk rewards, products, returns that have been locked on the balance sheets of financial institutions for the last 40 years are on their way to you as investment products. We're all going to have to overcome biases that we have about public and private. Other big change, indexation and correlation. Do we have price discovery in US markets? I don't know. 83% of the US market is S&P 500. 10 stocks are 35% of the S&P. Those 10 stocks trade at a 45 PE today. How many of us come in every day trying to buy 45 PE stocks? Probably none. On the other hand, think of the largest pool of capital in the world today. $12 trillion sitting in 401k for US, mid-market investors, people who really need returns. What are these people invested in? Daily liquid index funds for 50 years. Why? Why do we have people invested in daily liquid index funds for 50 years? And it'll go to where I think change is really coming. We are going through an entire evaluation of public versus private. In my 40 years, I certainly grew up thinking public is safe, private is risky. And for most of my career, that's been true. Private was 3 products: venture capital, hedge funds, and private equity. All 3 are risky. Public was safe. In the US at least, 8,000 public companies, diversified portfolios of stocks and bonds. What if that's not the case anymore? What if private is both safe and risky, and public is safe and risky? How should we think about investing? How should we think about portfolios? Most of us, most institutions, operate with a private bucket or an alternatives bucket. Why don't you have a public bucket rather than a private bucket? We went from 8,000 public companies in the US to 4,000 public companies, and I would bet that's going to go down, not up. Shouldn't we have half our money in private? I think we've looked to private markets for rate of return because we've always perceived it as more risky. Therefore, more return is desired. I think we're going to look to private markets for diversification. I think to escape indexation and concentration. I think we're going to look to private markets. I think we're going to think rethink a whole notion of risk and reward. The things that we've taken for granted, that public is safe and that private is risky, that banks are a sort of debt financing, that daily liquid. By the way, why do we have daily liquid funds? I don't know. Why does an institution with a 20 or 40-year time horizon concern itself with liquidity? I don't know. We are breaking taboo. Investors right now are confused, and they're confused because they're looking back at history and they're saying this worked. But what they're not yet willing to do is to question the fundamentals. Is the system totally different? Have things changed? Are we in the absence of tailwinds? Am I willing to revisit underlying assumptions? Think about the following, like coming back to the notion of price discovery. Active management of equity is a really difficult business. Very few people do it really well, have the discipline, have 60 teams. If I told you there was a market where for 20 years, 93% of the participants failed to beat the index, you would be concerned. Did these people get stupider? I don't think so. Well, has the structure of the market changed? I think the structure of the market has changed. I think the whole notion of daily liquidity is going to change. We are betting on that. We've built a business that is $650 billion today, which will be twice its size in 5 years, based on a bet that investors are going to revisit how they think. It is already happening. So if you take the typical investor, and I'll take your portfolio, but then I'll simplify it. Typical institutional investor that invests with us is 50-ish% invested in public equity, daily liquid, 30% invested in fixed income, daily liquid, and 20% in everything else. Why? No one knows. That's what we've done. That's what's worked historically. And we're actually watching this change in real time. And the place it's changing first is in fixed income. A single A-rated private security. Is that an alternative or is that fixed income? I ask CIOs this question all the time. It can stump them for an hour. Because we've all grown up thinking this thing doesn't exist. We are watching institutional investors look at their fixed income portfolio, and they are moving their fixed income portfolio not into public and private, but into alpha and beta. We are going to watch a turnover of the fixed income portfolio of institutional investors move into private markets. And the reason that's happening is there's an arbiter. There's a rating agency. Someone can say, this was A-rated, this was A-rated. You can pick up 200 basis points of yield from moving. Therefore, we should move since we don't need the liquidity. What about if the same were true in equity? What if people took their 50% equity bucket and they actually thought about diversification, they thought about the number of public companies, and rather than think about private equity, because private equity, and I know the debate is taking place in this country in real time, private equity is levered equity. It's in a fund structure. It produces some binary outcomes. What if we talked about equity that's private rather than private equity? That's going to be a harder move for people because there's no rating agency yet that is willing to allow people to talk across a spectrum in public and private and equal risk. But that's the world we live in today. More companies are going to be private. People who are not invested in equity that is private are missing out on half of the marketplace. They are concentrating their portfolios. The notion that their public portfolios have performed well in the past does not surprise me. We are indexed and correlated. We have been driven by money flows. We've printed $8 trillion in the US. 100% of last year's return was essentially 10 stocks. Everyone has woken up and discovered that they own NVIDIA, Apple, and Amazon, and Microsoft, and is levered the same way. It's not clear to me that that's sustainable. And for me, as a leader of a business, I think Adam's notion of humble confidence is actually a really good one. We all are confronted with change. we're all confronted with uncertainty. But while we do the little things to deal with change and uncertainty, and we reflect contrary opinion and we allow for intellectual insubordination, how many of us actually force the organization to fundamentally rethink whether the things we think are true are true? I want to challenge that. I want all of you to think about that. I don't think what we've grown up in exists anymore. I don't think the financial system works the way we think it does. I think liquidity is different, the sources of debt are different, indexation and correlation are different, the whole notions of public and private are different. And I don't think the strategies that we've employed over the past 40 years are going to work going forward. That's a really uncomfortable thing for us to deal with, because we're all used to doing due diligence and looking at track record, looking at historical correlations. It's not clear to me that that is any value. Thank you. This has been great.
Thanks, Marc, for adding depth to our conversation and for flying all the way to Norway to speak to us. The world's best investors believe there is one characteristic which is consistent in excellent investors, and that is grit. Angela Duckworth is a Rosalie and Egbert Chang professor of psychology specializing in grit and self-control. She's an academic, a psychologist, a popular science author. Angela believes that it is in times of adversity that we see a separation of those that are good from the very best. Please help me in welcoming Angela, who's joining us online today.
Hello, greetings from Philadelphia, and thank you very much for having me. It's my honor to follow Marc and to say that, in a climate of uncertainty and change, but also I would say, historically across time, that there has been a quality of the highest achievers in every domain, at least every domain that I have studied, and that includes leadership. So I'd like to present to you today what I have discovered about what grit is, why it's special, and what this means, especially in the leadership context. I want to say on a personal note that I grew up with a father who only talked about being a world-class achiever. Literally, that's all we talked about at breakfast, at dinner, on the weekends, summer vacations. And my dad talked a lot implicitly about how the highest achievers were naturally talented. They were smarter than everyone. They were more gifted. And what I grew up to learn as a psychologist is that talent, innate talent especially, has nothing to do with grit. Let me show you 4 questions from the grit scale to give you a sense of what I'm talking about. Here's an item that indexes your perseverance for long-term goals. Ask yourself whether, if I talk to your closest colleagues, whether they would rush to tell me that you are an especially hard worker. Would they tell me that you finish whatever you begin? This item, by the way, also an index of your perseverance for long-term goals, is the single most predictive item on the grit scale. So this is probably what you think of when you think of grit, someone who's really a hard worker, also resilient in the face of setbacks. They finish things when a lot of other people quit. And I would tell you that that is half right, because that is half of grit. But grit is also passion for long-term goals. And let me show you 2 items from the grit scale that index your passion for long-term goals. And before you read them, I need to warn you that they're reverse scored, meaning that if you read them and you say, wow, that's just like me, that's how everyone would describe me, then actually you get a lower passion score and a lower overall grit score. For example, I have difficulty maintaining my focus on projects that take more than a few months to complete. Or I often set a goal, but later choose to pursue a different one. Given that I'm following Marc and his comments, I do want to say, importantly, that when I study grit, this combination of perseverance and passion for long-term goals, I want to say on the passion element that in the context of uncertainty and change, now more than ever, what I mean about passion for long-term goals is a kind of steadfast and even stubborn dedication to some top-level goal. It's usually very abstract. It can even be so abstract as to not be easily understandable by other people. But you want extreme agility and flexibility on how you're going to get there. And I think that reconciles in some ways the current environment of uncertainty and change with this timeless character strength of grit. Now, I said that in my research that I found grit and talent to be not at all related, and that's exactly true. In my research and in research from around the world, when you measure IQ or other kinds of natural ability, you find that IQ is great. It predicts achievement, but it's not correlated with grit, which I think is at least as essential. And I want to share with you one personal relationship that I have with a paragon of grit, because I think he illustrates how talent and grit are different and how grit in some ways unleashes the talent that people have in order for them to accomplish great things. Meet Toby Cosgrove. Toby Cosgrove grew up. He was a very mediocre student. Turns out he had dyslexia, a reading disability, but in those days they didn't have a word for it. They just thought he was slow. But he wanted to be a doctor, and he eventually got into medical school, and he eventually graduated from medical school. When it was time for him to choose his specialty, he wanted the hardest one. So he chose heart surgery, and it was the most competitive, and everyone told him he couldn't do it. But Toby did it anyway. He was told while he was a resident in heart surgery, cardiac surgery, that he was the least talented individual there was. And he didn't disagree with that, but he believed that he could learn from his failures. Failure is a great teacher, he said. And Toby went on to work and work and work at refining the craft of cardiac surgery. He said he was on a constant quest to find ways to do things better. And I want to share one very specific story from Toby's early years as a cardiac surgeon. He realized that there were other surgeons in the world who were far better than he was. So he would go to see them. He would get on a plane, like Marc did, and he would travel, and he would stand in the operating theater, not operating himself, of course, and he would take notes, and he would watch like a hawk. And these discovery trips, as he sometimes called them, he would come back, and then he would have a goal. He would have a picture in his head of something he could do better, that he would try to do as best he could, and then to refine and refine and refine and to improve. And I want to share with you how this links up to what is sometimes called the 10,000 hour rule. 10,000 hours of practice. Now, it's a dark auditorium, and I'm in Philadelphia. I'm not with you, but I'd like you to raise your hand if you've ever heard this expression, 10,000 hours of practice. 10,000 hours, makes you great at what you do. Well, I know it's not the same country, but I do want to say that in Sweden, there was born a scientist named Anders Ericsson, and he was the scientist whose research became popularized as the 10,000 hour rule. Now, Anders was a dear friend of mine. He passed away several years ago, but he spent his entire life as a cognitive scientist trying to understand the learning curve of world-class experts. So, grand chess masters, Olympic gold medalist athletes, prima ballerinas, world-class mathematicians, etc., etc. And that expression that you've heard of, 10,000 hours of practice, comes from a single study, just one of his studies, that showed that at a German music academy, the very best musicians, those who would go on to recording contracts and achieve world-class prominence, they had on average about 10,000 hours of a certain kind of practice. The next group had less of it, maybe 7,500 hours. And the worst group, who were still pretty great because this was a selective German music academy, they had maybe 5,000. Now that became popularized as a kind of heuristic, a rule that the quantity of practice makes you great. But I want to show you a different learning curve that Anders also discovered. And this graph essentially summarizes his lifetime of insight into how to become world-class at what you do. You can put in 10,000 hours or 20,000 or even 40,000 hours of a different kind of practice, a less effective kind of practice, and actually stop improving, unlike world-class experts. I call this the plateau of arrested development. And I think it makes the point that it's not just quantity of practice that makes you world-class. It's the quality of the practice you're doing. Now, I want to unpack that for you very specifically because I think there's a lesson in that for every leader, for every investor, and indeed every performer who wants to get somewhat better every day at what they're doing. Before I unpack that, I want to show you another learning curve. I have 2 daughters, and I raised them to believe that life is a multiple choice question. You have a choice of improving every single day at what you do. That's the path to becoming a world-class expert. There is plateauing at some level of mediocre performance. You know, you get better in your first year, you get a little better in your second year, but maybe in your 4th or 5th year, you're just on autopilot. That's probably most people. And then there's a third choice for you in life, and that is to drop out of what you're doing. Now, especially given Marc's comments and my own personal history and what I've learned as a scientist, I want to emphasize to you today that dropping out is sometimes exactly the thing to do, especially when there's some low-level goal, some tactic, some quarterly objective that's just not working out, or when the opportunity cost exceeds what you're doing right now. Those are excellent reasons to drop out. I played piano when I was a little girl, and I'm so glad I quit because I wasn't very good at it and I didn't love it, and I was able to take my time and devote it to something else. But what you find about every world-class investor and every world-class leader is that they eventually find something that they love enough to keep with it, to stay improving and improving, to have passion for that long-term, top-level goal that keeps them motivated. Now, here is what Anders Ericsson discovered about high-quality practice. It has 3 specific elements, and they're quite easy to understand, but maybe not easy to do in combination. The first element is that you must decide on a very specific, narrow aspect of your overall performance, and you drill that in particular. So if you ask an Olympic athlete, a skier, like, what are you doing? They're not going to say I'm skiing better. They're going to give you a very technical answer that you probably only understand if you were also a world-class skier. Now, they do this usually with a coach helping them, but when they practice, they usually practice alone. So Anders discovered toward the end of his career that almost everyone needs a mentor to show them and to help them identify what to do next. But when they do the work, it is almost always alone, so they can concentrate completely and really pay attention to what they're doing. So the second element is practicing with complete focus, the opposite of multitasking, if you will. And the third element is the hardest motivationally, psychologically, I would say, which is that you have to get feedback on what you're doing, feedback on that performance, and then to repeat the cycle again. And I say it's the most difficult motivationally because if you tell me one thing that I could have done better for you today in my 15 minutes with you, I will immediately be defensive. I don't want to hear you criticize what I just did. But if I ignore your feedback, then I will never get better as a speaker. And so this feedback is the essential element, closing the feedback, closing the learning loop, but also it's something that is the enemy of ego. Now, if you are somebody like Toby Cosgrove, you do this kind of deliberate practice day in, day out to become a better cardiac surgeon, you have a top-level goal. Let me show you what a hierarchy of goals looks like for somebody like Toby Cosgrove. All human beings have goals, but what makes gritty people special is that there is a top-level goal for which they have so much passion and perseverance that they don't give up. For Toby, that was to improve the patients' lives that he was working with, both the quality and the length of their life. And to achieve that goal, he had mid-level goals, prevent cardiac conditions, treat the conditions, coordinate care. And then there were these low-level tactical goals that he should be more flexible and agile with, but he should be very stubborn about the top-level goal. Now, I want to say what happened to Toby. So he became arguably the best heart surgeon in the world. He invented many procedures that are still in use today. And then he became a leader. He became a real leader, and he became the CEO of the Cleveland Clinic. Now, the Cleveland Clinic is one of the world's most renowned medical facilities, and suddenly Toby had to understand how to lead with grit, not just how to be a performer with grit, but a leader with grit. And I want to end with this insight. I believe that what a gritty organization is, a gritty company, for example, is in a way, it's a macrocosm of what a gritty individual is. So there is still a top-level goal. There is a goal hierarchy with mid-level goals and low-level goals. I believe that the top-level goal, in this case, when Toby took over the Cleveland Clinic, he made the top-level goal, put patients first. Just those 3 words. Everybody walked around with buttons that said, put patients first. When I talked to the secretaries and the custodians, anybody at the Cleveland Clinic, I said, what's this place all about? They said, put patients first. Every single one of them told me that. Now, they all had different jobs, right? They all had different functions. There was a hierarchy, but there was this steadfast, stubborn dedication to a top-level goal. And I want to say in conclusion that if you believe that talent is not enough, if you believe that it's not enough to be lucky, if you believe that in addition you need to have passion and perseverance at the individual level as a performer, you must also believe that you need that at the organizational level. And that to me is the essence of leadership with grit. In the words of the great American writer Ralph Waldo Emerson, any institution is the lengthened shadow of its leader. When I find gritty leaders, I find gritty organizations. When I find gritty organizations, I find gritty leaders. There is a top-level goal that motivates both. And on a personal note, I will say the reason I am so delighted to be with you is that I think Nikolai is truly a great leader. He leads with grit and integrity and has been an example for me for many years. So in friendship and in admiration, I say thank you.
Thanks to Angela for sharing her views, who I'm sure is continuing to watch us live. It is now time for a break. We all resume at 15:40 for our last session on behavioral aspects of excellent investors. Now, we've heard a lot about what makes a great investor. A great investor is someone who knows a company in depth. Some people go all the way when it comes to learning what the company is all about. We sent one of our employees in the real world to check out some of the companies we own. Let us see how that went.
Hi everybody, live from McDonald's today, really good, best price. Now, in the fund, we own shares, the equivalent to 400 million Big Macs. Now, when you see me with the football, you're probably going to mistake me for Haaland. And we are nearly from the same place in Norway, but not quite just. Put on my really good sliders today with my very typical Norwegian socks. Going into some proper deep learning here. We are folding pizza box. That only took me 5 minutes. In the podcast, one of the things we spend a lot of time on, the secret sauce. And you know what? In this case, here it is.
What do you reckon, Nikolai?
Perhaps a little bit too much tomato sauce. Love it. I think we put on a bit more.
I guess Nikolai should have listened to our next speaker a little bit more when it came to quitting on that tomato sauce. Because our next speaker is a master of knowing when to quit. Annie Duke is a world-class poker player, but she's also the author of the best-selling book, Quit. She's here with us today, joining us online. Welcome to Annie.
Hi, everyone. I'm so happy to be here virtually. I'm going to talk to you today about quitting, and particularly how do we improve our exit decisions and why do we really want to do that? So the problem that we have as decision makers is that uncertainty makes it very hard to start things. And that's because there's two forms of uncertainty that are exerting themselves on any decision that we make. The first is just plain luck. Which means that we can make a great decision. We can make a decision that's going to work out 90% of the time, but 10% of the time it's not going to work out. And when we observe that 10% is wholly determined by luck. And that makes it very hard for us to start things because we're trying to get more control than we actually have over what the outcome might be, which is probabilistic in nature. The other form of uncertainty that makes the decision to start things hard is that we know very little in comparison to all there is to be known. And so this can make it so that we really slow our decisions down in a way that isn't actually productive, trying to get to a level of certainty that is actually unattainable. So those two forms of uncertainty are making starting things hard. The good news for us is that for most things that we decide to do, we have the option to quit later. That quit might have varying costs associated with it, but almost anything that we decide to start, we can actually quit. And what that means is that the uncertainty that makes it really hard for us to start things, this option to quit later makes that start easier because we can anticipate the ability to exit when we observe that the world isn't going in our direction, or when we observe that we're getting signals that we're learning new things that tell us that our choice wasn't actually that good. So you can think about it like, we've all had that feeling of, I wish I knew then what I know now. The option to quit actually makes it so that we can act on that feeling when we learn new information. But here's the really big problem, is that even though we have this incredibly valuable option, and I would actually argue that it's the single most valuable option that we have in decision making is this option to walk away, the problem is that we actually are quite bad at quitting. We tend to walk away from things much too late compared to when, if you were just judging expected value, would be the correct time to actually walk away. So we're going to talk about this problem that we have with quitting. We're going to talk about why it is that we have such a problem with quitting. And then I'm going to hopefully give you some solutions that are going to make this all a little bit easier for you. Okay, so here's the important thing. Remember, I said, after we start things, we get new information. And we have this very strong intuition that when we get information from the world that things aren't going that well, we'll actually pay attention and walk away. So when we get those adverse signals, we're going to stop what we're doing. And that's what we all think. But that intuition is actually wrong. Instead, in the face of those negative signals, we escalate our commitment. And actually, in reference to the previous speaker, I use mountain climbing as an example for this. We've all heard of summit fever. We have the intuition that if it gets dark and we're still climbing, or if a blizzard is coming in, that we're all going to stop climbing. And it turns out that we don't. And you can just look to, for example, 1996 on Mount Everest to know that people will continue past the point when they already have adverse signals, 1996 being that tragic year when Rob Hall and Doug Hansen died. So this is a well known effect. It's called escalation of commitment, that we get these signals, and instead of actually reducing our commitment to the cause, having gotten those adverse signals, we actually escalate our commitment to the cause. And of course, continuing to do something that is no longer worthwhile doesn't just have costs associated with doing something that's negative expectancy itself, but there are also opportunity costs associated with it. So we have this added cost of failure to cut our losses, that we can't take that capital, our time, attention, our money, our effort, and put it into something that would actually be worthwhile. So one of the ways that we can think about the grit and quit is not as oppositional, but is kind of the same decision. We should stick to things that are worthwhile, and we should quit things that aren't. And the failure to quit things that are no longer worthwhile also has opportunity costs associated with it. So this becomes even more important to get this grit-quit decision down. Now, this is really important. Experts are in no way immune to escalation of commitment. They're in no way immune to this failure to quit things on time. There's lots and lots of data, and I've got 3 studies shown here, Garvey and Murphy, Woodcock, so on and so forth, that show that while expert investors are alpha generators when putting risk on, they give alpha back on their exit decisions. And in fact, this 2023 paper showed that endowments, when they put positions on, are generating between 120 and 180 bips on those in alpha on those decisions, but their exit decisions, they're actually giving about 70 to 80 bips back. Woodcock and then also Garvey and Murphy talk about the fact that intraday traders are also finding this, and Alex Emas has shown this as well. Very, very good on the entry, giving a lot of that alpha back on the exit. And that's why I think this option to quit is so incredibly valuable, because this is the place where we can actually we can generate a lot of alpha compared to our competitors. So why is it that it's so hard for us to quit things? Well, it turns out that there's a lot of cognitive biases that kind of pile up on top of us that make us slow to quit. I'm going to walk through some of them pretty quickly. I'm not going to cover every single one of them, but we have the sunk cost effect, endowment, status quo bias, omission commission bias, optimism bias, loss aversion, and sure loss aversion. So I'm going to walk through these somewhat quickly. The sunk cost effect is when we take into account what we've already spent on something and deciding whether to continue on and spend more. In other words, what happens is that we have that feeling of we want to get our money back, or we don't want to have wasted what we already put into something. The problem, of course, is that waste is not a retrospective problem. It's a prospective problem. What we'd ideally like to do is, if it is something that we would start today, then we should be willing to continue it. If it is not something that we would start today, then we should not continue it. But what happens with sunk cost is that instead of this forward thinking where we're saying, is this something that we would actually start today? Would we put this position on today, for example? We take into account what we've already put into it in deciding whether to continue on and spend more. Now, the problem is it doesn't really matter what you've lost coming up to that moment of the decision. What matters is whether the next dollar or the next unit of effort that we put into something is positive expectancy. So the sunk cost effect causes us to continue things that are no longer worthwhile. We also have the endowment effect, which is just we value things that we own more than identical things that we don't own. So the things that we already have in our portfolio, the positions that we already have on, this is even true of our own ideas, the theses that we're trading, the ideas that we have, we value more than things that we don't own. So obviously when we're making that decision about whether it's worthwhile to continue on, we're going to distort our view of what the expected value is, just because we think that the things that we own are more valuable, that they have more value to them. Then we have sure loss aversion. This comes from the late Danny Kahneman and Amos Tversky, which is essentially this problem that we're biased against converting paper losses into realized losses. And we'll actually pay to avoid having to do so. So this is from their original 1979 paper on prospect theory, which shows that when people are in the losses on a gamble, say I've lost $100, and I'm offered a fair coin flip where I can either get even or I'll lose $220, that they'll prefer to take the flip there. In other words, they're paying $10 for the opportunity to try to get even. And that's because of this aversion to turning a paper loss into a sure loss. And obviously, that's a huge problem when we're in the losses on a position that we're holding. And we can kind of think of all of those under this umbrella of we just don't like to close accounts in the losses. And it's not just paper accounts. This has to do with our mental accounts. So we can have a paper account that's in the gains, and yet our mental account is in the losses. If we buy a stock at 50, it goes up to 75, and then it goes down to 60. Mentally, we're in the losses, even though on our paper ledger, we're in the gains. And so this problem with not wanting to close accounts in the losses makes us very slow to quit. We also have status quo bias, a preference for sticking with the status quo. Omission, commission bias. We're much more tolerant of losses that come from sticking with the status quo. In other words, making a decision not to switch, as opposed to making a decision to switch. So if we're holding a position, we're going to be more tolerant of the losses that might generate from that than we are going to be tolerant of generating from losses that come from us switching from that position to something new, which also makes us very slow to quit. And then the last thing is just cognitive dissonance, identity, and validity, both the way we view ourselves and the way that other people view us. We want to be seen as consistent individuals over time. Part of the decisions that we make create part of our identity, and that's particularly true if those decisions are making us stand out from the crowd. So Beshears and Milkman showed that when analysts take positions that are non-consensus, on earnings forecasts, when they're non-consensus and the world turns against them and gives them information that their forecast actually wasn't correct, they'll actually double down on the forecast. But when they make forecasts that are in consensus, they're perfectly willing to change according to what the world tells them. And that's because the non-consensus forecasts are actually much more part of somebody's identity. And obviously, as traders or as investors, we're investing against the market. So we're often trying to stand out from the crowd, do something where we think that the market is not efficient. And that makes it actually much harder for us to walk away because it's an attack on our identity if we actually have to jump ship. Okay, so I told you a lot of the reasons why we don't stop. Now I want to give you quickly a few reasons how we can help you to get better at these stopping decisions. The first is to set very specific kill criteria, which are just criteria for killing a project, cutting your losses, or changing a plan. So the first step is to identify the way that things might go wrong or right, and then identify the early warning signals to develop a list of kill criteria. In other words, what are those signals that I think I might ignore in the future that would tell me that it's time to walk away? And then pre-commit to your reaction to those criteria. So I've worked with a lot of investors, and they have that intuition. Well, I have a thesis. And let's say the thesis has to do with the directional movement of interest rates. So their thesis is that interest rates are going to go above a certain point. Or stay within a particular band or go down, whatever that thesis is. They have the intuitions that when interest rates move against them, that they will get off the position, that they will take risk off. But we know that they don't. They tend to get thesis creep, or they escalate our commitment, or they say, now it's really cheap. I know my forecast is still correct. And so what I'm doing here is saying, okay, if you have a thesis, that thesis is implying certain things about what the world is going to look like in the future. Write down what that thesis is actually implying, and then develop kill criteria. In other words, if interest rates move out of a certain band, then I will do X, Y, or Z. So if they go above a certain band, maybe I'll put more risk on. But if they go below a certain band, that means that the world has moved against my thesis, and I need to actually take the risk off. Now, that might seem like a distinction without a difference. If I have a thesis, it's predicting certain things about the future. Why is it different if I just write those things down and pre-commit to them? And it turns out just cognitively that makes a huge difference. To think ahead, actually identify what those kill criteria are, and then pre-commit to the actions that you're going to take when you see those signals develop. The next thing is to create better feedback loops. One of the problems that we have on the quits when we take risk off is that we really don't have a good feedback loop on how those decisions compare to a benchmark. So we consistently track positions we have on. And obviously, because they're in our portfolio, we also even track positions that we're considering putting on because we'll create shadow books. But what we don't do is consistently track positions that we take off. So what we want to do is create a benchmark against which we can actually measure the quality of our quitting decisions. So we can do that in a couple ways. One thing is, for example, if we're freeing up capital, we can create a benchmark, which is what if I randomly freed this capital up from anywhere in my portfolio and actually judge my quit decision against that over the course of a period of time. You can also actually start to track your things that you hold and look at what would have happened if I had actually sold those things earlier at the time that I considered it. But be creative and try to actually create benchmarks against which you can actually start to judge your quitting decisions so that you can start to get feedback on whether you're generating alpha on those exit decisions or giving alpha back on those exit decisions. And the last is, this is a big favorite of mine, go get yourself a quitting coach. Because an honest broker, someone who's standing on the outside looking in on your situation, is going to see your situation more clearly than you can. And the reason is that they're not carrying all of the sunk costs. They're not carrying the endowment. They don't have the same kind of biases piled up on them that are making them not be able to see that situation so clearly. So someone from the outside looking in is going to see your situation more clearly than you can. And so if you work with them to pre-commit to an exit plan with a quitting coach, it actually makes it more likely that you'll follow through. So they can both see the decision more clearly than you can, and they create accountability that are going to make you actually follow through on those quitting plans. So actually, when I've worked with, for example, solo PMs, I've paired them together so that they can coach each other on these exit decisions. So I hope that this bit about exiting you're going to find helpful. I really believe that this could be the single biggest alpha generator for you right now in your own investing life because we are so bad at it and nobody's really paying attention to how good these exit decisions are. So if you can get better at these exit decisions, I think this will vastly improve your returns. Thank you so much.
So a great thanks to Annie for sharing thoughts on how and when to quit. It's a pleasure to introduce the next speaker, Michael Mauboussin from Morgan Stanley. Michael is a Wall Street investment strategist. He's an author, and he's an adjunct professor at Columbia Business School. Now, Michael is known for his ability to turn complex ideas into strikingly simple language. So with that, Michael, please.
Good afternoon, everybody. It's really great to be with you. The goal of my session is to talk about two very specific blocks to potentially poor decisions and what the best investors do to overcome them. The goal of session 2 is to be very practical. I hope when you go back to your desks, you'll immediately be able to implement some of these ideas and ultimately make better decisions. Adam Grant mentioned earlier today the Good Judgment Project, a project at the University of Pennsylvania on forecasting. It turned out they did something very interesting. When forecasters volunteered to participate in their project, they either in control gave them no training or they gave them some training. And the question was, did the training make them better at making better forecasts? And the answer to that was yes. But it's actually somewhat qualified. There are different flavors of training that have different impacts. The first is just giving people information about heuristics and biases. And it turns out, you could do a couple experiments, it turns out it's really fun for people, they enjoy it, and then they walk back to their desk, they do exactly what they were doing before. So it doesn't change any behavior. The two that we want to focus on is process, so very specific tools and techniques we can work on to uncover biases, and then finally giving people feedback, certainly a theme that's come through a lot today. There is a little bit on format, so how you can reframe problems. I'll give you one example that's a little bit in that flavor, but we're going to focus mostly on process and feedback. So let's jump into this. I think the first very big barrier to making good decisions is the notion of overconfidence, and I think the best investors are very good at overcoming this. Now, it turns out overconfidence, which is often considered the root of all problems, comes again in different varieties. The first, I would say at the very bottom, is this idea of overplacement. People think of themselves as better than they are versus others. So you've all heard this, I'm above average driver, or my sense of humor is better than 90% of other people. The other is the idea of overestimation, which people absolutely think they're better at certain tasks, so I can make this 7-foot putter or whatever it is. So overplacement. But the one that we're most interested in, I think, is this concept of over-precision. We actually think we understand the future better than we actually do. And I think the really good investors are those that can combat and overcome that. Let me give you an example of how this works. This is a sort of a test of calibration, in some degree a test of overconfidence. By the way, the URL is down there. If you can't find it or to see it, just let me know. It's a very fun exercise to do in your own organization or with your loved ones. It's 50 true-false questions, some of which you'll know the answer to, many of which you will not know the answer to. So you answer true-false, and then you give a confidence. 100% means I know the answer to this question. 50% means I don't know the answer, and I'm guessing. Right? So this is the basic setup. Now, we've had now about 20,000 people do this exercise, and this is the scatter plot of all the responses. By the way, I do want to mention two, and I'm sure they're guys. I'm going to mention two guys that are my two favorite dots. The one is the upper right-hand corner, which is 100% correct and 100% confident. So this guy Googled everyone, and the second guy that was even better is in the bottom right-hand corner. He is 35% correct and 95% confident. You just said true, 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 true. You do better than that guy did. Now, the goal of this exercise is not to be right about every question. If you can be right, that's great. But the goal of the exercise, as you might imagine, is to know what you know and to know what you don't know. The goal of the exercise is to lie as close to the 45-degree angle line as possible. Now, even people in the very back of the room can probably see this. When I give you the numbers, you won't be shocked to hear this. The average confidence is 70%, and the average correct is about 60%. People are 10 percentage points overconfident in their own judgments. Now, let's unpack that a little bit to see if there's anything interesting. Well, the first is the distribution of overconfidence versus underconfidence. By the way, I mentioned this 10% overconfidence. It turns out the standard deviation is also 10, so it's a beautiful shaped Bell distribution when you have this many people. And about 82 or 83% of people are overconfident. That's something we see very consistently. By the way, as a side note, and I'm glad you're all sitting to hear this information, men tend to be more overconfident than women. And young men tend to be more confident than older men, so there's some patterns there. Now, this is where it gets really interesting. It turns out that how do people answer when they're doing this exercise, right? So again, you're getting 50% means I guess, so I don't know the answer, to 100%. So it turns out when people don't know the answer, they know they don't know the answer, and they answer they don't know the answer. So they're actually about 40% of the answers is I don't know, which is fine. What's fascinating is the second most common response is, I've got this. I'm 100% sure I know the answer. So between I have no idea what's going on and I know the answer is about 2/3 of all responses. And people are very sparing in using those intermediate ranges. By the way, as Adam was talking about super forecasters, he alluded to this, but super forecasters are much better at updating their views and being more granular in actually setting their forecasts. Okay, so how do people do given their confidence? Well, this is the most fascinating chart. Turns out when people don't know the answer, again, they answer if they don't answer, and they're pretty well calibrated at I don't know. But as you move from left to right on this chart, you see this systematic departure from the 45-degree angle line. When people are 100% sure they know the answer, they're only right 77% of the time. When they are 90% sure, they're only right 2/3 of the time. Right? There's this yawning gap, especially in this range of I'm very sure what's going on. Howard Marks remarked about this just this morning, that this is the sort of the Mark Twain thing. When you're very confident about something and you're wrong about it, this is where trouble can arise. This is also very, very important for portfolio construction concepts. By the way, there's an interesting, there's a brand new paper about this, but there's a new survey, there's a group called the Survey of Professional Forecasters that forecast economic things. So this is unemployment rates and interest rates and so forth. And they have a data set going back to 1968, so 55 or 60 years of data on this. And it's the exact same thing. They say, what's going to happen with this thing with some sort of probability. And here again, these are professional forecasters. And here you see this exact same pattern unfold. High confidence, poor conviction. Now, why is this, what's exciting about this, on the other hand, is going back to the concept of feedback, is it turns out when people get feedback on their forecasts, they get better at it over time. So this is a picture of actually weather forecasters. The line at the bottom is actually the first year they did this. And these are large sample sizes. And then the next year, they repeated the exercise with the feedback from the first year, and you can see they got markedly better. So this should be very encouraging to all of us, that if we practice and get the feedback, we get better at this, right? But keeping track of your decisions is really crucial to this. Okay, so what's going on here? How can we improve, broadly speaking? What do the best investors do? Andy mentioned Danny Kahneman. We all mourn his loss. He was extraordinary. But one of the concepts that Danny popularized is this idea of the inside versus the outside view. See, the inside view says when I give you a problem, it could be any kind of problem, the classic way to solve this, see if this makes sense to you, is you gather lots of information, you combine it with your own experience, and then you project into the future. Right? Left-order devices, that's what we do. Information, my experience, what's going to happen in the world. The outside view, by contrast, says, I'm going to think about my problem as an instance of a larger reference class. I'm going to ask what happened when other people were in this situation before. It's a very unnatural way to think about the world, right? Because you have to leave aside your cherished information, and you have to find and appeal to the base rate. What psychologists like Kahneman have demonstrated is some combination of the inside and the outside view lead to better forecasts. Let me give you one example from the world of business. This is Peloton, right? And this is an analyst report that was written in September 2020. So please roll your mind back 3.5 years to the middle of the pandemic. They were doing great because everybody wanted to exercise while they were at home. They had just finished a blockbuster year, 2020. And the analyst wrote in his report that our base case scenario is they're going to grow revenue 30% for the next decade. And by the way, it's a very, I'm telling you, the guy's a serious model. He's got it, it's all built out. It's actually quite credible. So that's his inside view. Now, the question you are going to ask, hopefully using the Danny Kahneman mindset, is how many companies with $2 billion of turnover grew 30% a year for 10 years? And here are the data on this. I put the Peloton bike, the guy's forecast. But you can see the average is about 6%. The standard deviation is a little bit more than that. This is the guy's base case. So you might say if he's wildly optimistic, he should certainly have a scenario for that. But that certainly would not be your base case. Right? So this gives you an example of how you might temper that. There's a great quote from Danny Kahneman, by the way, which really applies to investors. He says, people who know information about their own individual circumstances feel no need effectively to appeal to the base case, the reference class to which it belongs, right? You feel like I've done the work. I don't need to know what happened in the rest of the world. When we know combining these two things is very powerful. So why do we do this? A few reasons. One is, Andy just mentioned one of them, but one is called three illusions. One is called the illusion of superiority. We tend to think of ourselves as better than those around us. By the way, why do I have a picture of Mother Teresa? 25 years ago, U.S. News and World Report did a survey of 1,000 Americans, and they said, what's the probability of going to heaven? And they talked about, they asked about Michael Jordan and all these people. Anyway, Mother Teresa scored 79%, which seemed a little low to me, by the way. She's now a saint, so maybe people will bump it up. But this is the best. Mother Teresa, 79. They said, you, survey answer, what is the probability you'll go to heaven? 87%. Mother Teresa, I promise you, I would not answer higher than Mother Teresa. The second is the illusion of optimism. We tend to be very optimistic about our outcomes that are important to us, and so as a consequence, we tend to over-calibrate our success. And then the illusion of control. This is good. When we deem ourselves in control of a situation, we think our odds of success are much higher than they are objectively. It turns out when they go to Las Vegas, watch people rolling dice, when they want high numbers, they throw them really hard.
When they want low numbers, they throw them very gently. Doesn't work, by the way, but just this idea of being in control of the situation. Here's the last thing I'll say on this, which you can all relate to, which is this is statistical thinking. And it turns out in the real world, what carries the day are stories. Your parents told you stories. You tell stories to your children. Stories move people. Stories teach people. Stories are memorable. Statistics are not. So this is an interesting experiment where they went to people and they said, you have a horrible disease. You have a treatment alternative. It's always 50-50. So you have that in your back pocket. And then they said, we're going to give you, or they're going to show you one of four alternatives, 30, 50, 70, or 90% probability of success. So this is, you see one of those. But the key is they paired it with a story that was positive, negative, or neutral about someone like you, right? So hopefully I'm making myself clear. Everyone's got 50-50, you're getting 30 neutral. Okay. So here, let me just draw your attention to the extremes. If you give people a positive anecdote, they select the 30% effectiveness. Now, 30 versus 50, they select it almost 8 out of 10 times. If you give them a negative anecdote, they select the 90. Now, 90 versus 50, they select it less than 4 out of 10 times. The stories swamp the statistics in people making decisions. By the way, extremely important as leaders, very important for you as you think about stocks and narratives that go around them. Let me now turn to the second major problem. This is very much involved with what Annie was just talking about. I'm going to say it's confirmation bias. Confirmation bias, as you all know, even if you struggle to make a decision, once you've made a decision, you seek information that confirms your point of view, and you discount, dismiss, or disavow information that does not support your point of view. Now, there's a very interesting point about confirmation bias. It turns out almost all the biases, heuristics, and biases that are out there that Kahneman and Tversky identified are mitigated to some degree by intelligence. So if you're a smarter person on average, you learn about them, you tend to do better. The one that's not true for is confirmation bias. This affects everybody, no matter who they are and how bright they are. 2005 was the first chance I ever had to meet Danny Kahneman. It was an extraordinary day, an extraordinary session. At the very end of it, I said, Danny, if there's one thing an investor can do to improve his or her results, what would it be? Without hesitation, he said, you must keep a journal of your decisions. Write down what you think is going to happen, why you think it's going to happen. He said, write the date and time. He said, by the way, note how you feel physically and emotionally about this. But the most important thing is, as you're expressing your variant perception, as you're expressing your view that's different than what's in the market for an investment firm specifically, he said, communicate using probabilities, not words. Because if you use words, they're going to be vague enough that you can massage them after the fact. But if it's a probability, it allows you to keep score. And here's the one thing I would say. If you're going to do a probabilistic forecast, you want 3 elements. One is an outcome that we can agree upon. Second, within a specific period of time. And then with some probability. So you might say, for example, weather is a good example. Tomorrow, there's an 80% chance it's going to rain tomorrow, right? So that would satisfy that. If you have those 3 ingredients, you are in business for doing probabilistic forecasts. Now, to give you some sense of how wild this can be, I did a survey with my older son. We put out 23 common words or phrases to a population of people, and we asked them to say, what's the associated probability you would assign to this word or phrase? And what you can see, the answers are all over the place, especially with the cognate. Now, this is for maybe native English speakers, but the cognate possible. If you say something is possible, people interpret this in extraordinarily wide ranges. So the reason you want to avoid words like that, it's a serious possibility we'll have a recession next year or whatever it is because A, you're not going to be able to keep track of your forecast and you're going to weasel out of it after the fact. But B, if you're communicating with someone, they may hear something very different than what you mean. And that's crucial. Now, the last aspect of this is, this came up a little bit before, but I think it's fascinating in Adam's comment. Is this guy I love. His name is Keith Stanovich. He's a developmental psychologist, most recently emeritus at the University of Toronto. He's written a lot of books, but he wrote a book in 2009 called What Intelligence Tests Miss. It's not the snappiest book title of all time, but it's pretty descriptive of the content. And what he argues is there's this thing called IQ, and more of it tends to be better than less of it, that's fine. And there's a thing he calls RQ, rationality quotient, the ability to make good decisions. He says that's really what's important. And they're kind of on different sliders. And we all know this, right? You've all gone to school, people who did really well in school and not so well in life. And we all know people who are not very good in school, but very good at life. This is this RQ, IQ. So what is RQ all about? it turns out there are two components to it. One is called instrumental rationality, which is a fancy way of saying you can achieve your objectives given your constraints. The way we think about this in economics is the axioms utility theory. The second one's the one I think we care about, and that is this idea called epistemic rationality. It's a fancy word of saying, how accurately do your beliefs map to the world? And by the way, you woke up this morning with a certain set of beliefs of how the world works. You wandered around. Information confirmed it. Some information may have disconfirmed it. What did you do in the face of that evidence? So here's a quote from Phil Techlock, which I love, and you heard this earlier today in a different form. Beliefs are hypotheses to be tested, not treasures to be protected. The best investors take that to heart. Beliefs are hypotheses to be tested, not treasures to be protected. Let's do this together. Ready? Late in the day. Here's an example of how we might do this, right? This is an example of how this works in integrating information. So imagine, hopefully I can read this. Imagine the Zapper virus causes serious disease that occurs in 1 in every 1,000 people. Say there's a test that can detect perfectly if you have the virus, you're going to be test positive. Additionally, let's say that the test actually has a 5% false positive. So if you don't have it, it's going to say you have it 1 in every 20 times, 5% false positive. Okay, so now we choose a person at random. We know nothing about his or her medical history, and that person tests positive for the Zapper virus. What is the probability from 0 to 100% that that person has the virus? Right? So the test, 1 in 1,000, test is perfect, 5% false positive. We have someone that has the virus. What's the probability? Anybody know this one? But notice you have like these numbers in your head. It's confusing. But what you're doing is integrating various pieces of information. And the answer is just a bit under 2%. And let me explain how to come up with that very quickly in a way that's easy to reframe the problem. Let's say there are 1,000 people, we're going to test all of them. First person, we're going to test the person that has the virus. They test positive, we put them in the denominator. We're then going to test the other 999, 5% of which will test positive. We put them in the denominator. So now our denominator is 51. We said we picked one person at random, they tested positive, 1 over 51, that's your 2%. Right? When I say it that way, it's easy to follow, no? But you're integrating different pieces of information, and that's what great investors are able to do quite effortlessly. Here's the last thing. This ties together a bunch of things earlier from Adam and also from what Annie just talked about. This is something called linchpin analysis. This comes from the intelligence community. When you're looking at an investment idea, what you want to do is identify the key issues that are really important for that. For most stocks or even asset classes, 2 or 3 things tend to be important. Pinpoint the working assumptions behind that, so-called linchpin premises. Advance evidence for or against that, and this is where you can come up with things like the devil's advocate. And then any indicators or signposts, right? So the way you can do this is say, we have a variant perception, here's what we believe is going to happen, and you write it all down in advance. The key to these signposts is that kill criteria that Annie was talking about. So I know in advance, if I have a thesis that's different than the market, I should pass these signposts on the road, and if I don't, then I must change my mind about what's going on. And then last, by the way, I did this with Chat. I was very proud of myself. I did this with ChatGPT. So this is like my generative AI thing. But this is just a winding road. This is how I really envision it, that you see these signposts as you go along. And if your thesis is correct, you should anticipate seeing those signposts. And if you don't see the signposts you expect, that is an opportunity, or in fact, really a challenge to change your view. So with that, let me stop. What the best investors do is calibrate well to start. They do that primarily by appealing to base rates. And second, of course, when new information encourages you or forces you to change your mind, you should change your mind when appropriate. Thank you very much.
Thank you very much, Michael. That was very interesting. And we will all take your test. I'm 100% confident about it. And I've written it down. Okay, our next guest is a real legend, Marc Andreessen, probably the best venture capitalist the world has ever seen. Hi, Marc. Good to see you again.
Hello, good morning. How's everybody?
We are really well, thank you. Now, Marc, where are we going to make money going forward?
Well, so in our business, the theory is relatively straightforward, which is we make money on technological disruption. And so we make money when these new startups form and either try to go take down a big incumbent or try to create some kind of new market. And so that's what we do. I think for the world at large, the challenge is just that there's a fundamental supply-demand imbalance between the amount of capital that's seeking productive economic investment opportunities, and then the number of those opportunities. And so I think there's a very large macro problem on making money in the economy, and tech and venture capital can only be a small part of that answer, but hopefully we will be a part of that answer.
Yeah, well, you are sitting in the middle of Silicon Valley and you kind of invented the internet. So kicking off the AI question, just how will the AI race pan out here?
Yeah, so the theory and the hope, certainly that we're betting against and investing hard against, is that AI, and specifically these new breakthroughs around AI, like generative AI, represent a new platform. And in the tech industry, that's a sort of very powerful concept, because the idea of a new platform in the tech industry is sort of a new foundational technology that you can then imagine reinventing thousands and thousands of application categories on top of. And the tech industry historically has been fueled by these platforms. The original one was the mainframe computer that then led to mini computers, client server computers, personal computers, mobile computers. And every time there's a platform shift, there's an opportunity to reinvent the industry and reinvent basically the entire ecosystem and all the different ways that people use technology and create an entirely new generation of companies. And so we certainly believe that AI is a new platform shift. We believe that AI is one of the really big platform shifts. We think this, the possibility exists that this is on par with a microprocessor. And so, we think there's an opportunity to take a very broad perspective here and invest in many different, both core technologies and also use cases of AI.
Where is the kind of fight going on just now? What is it about chips or money or people or electricity? Just what exactly is it?
Yeah, so the most dramatic thing about this sort of AI shift is that it's what I call an 80-year overnight success. And so the original paper on neural networks, which are the foundational technology of AI, was actually written in 1943. And then you had, over the course of the last 80 years, you had entire generations of researchers who basically try to make AI work, and for the most part weren't able to do it. In fact, when I was in school, 35 years ago, AI was a discredited field because there had been an AI boom in the 80s that didn't pan out. And so it's a technology sector that's sort of been in search of working products for a long time. Essentially, what happened was the breakthrough moment was in 2022, and it was the ChatGPT moment. And so it was, it's actually 79 years into the technology, but it was a breakthrough moment. And then it was a breakthrough moment of it went basically from not working to working incredibly well in one step. And the technology is not perfect yet. There's still a lot of work to be done, but it fundamentally, these products are just incredible already in what they can do. And they're far better out of the gate than the microprocessor was, or than the internet was. And so it's this kind of rare situation where you have this dramatic leap in functionality happening extremely quickly. As a result of that, basically every part of the tech ecosystem is trying to react and trying to figure out how to incorporate AI, or trying to build on AI, or trying to, basically compensate, figure out how to compensate for weaknesses in AI. Every single sector of the tech industry is reacting right now. There is a massive chip shortage. This is the biggest supply-demand imbalance in chips that we've ever seen as an industry. And so there's a massive fight happening there. There's a massive wave of data center innovation development. There's actually power. A lot of people are now trying to figure out how to power and cool these giant data centers. There's actually a resurgence of interest in nuclear power around these data centers. And then there are basically fights happening up and down the software stack. The fight that gets probably the most publicity at the moment is the fight between the software companies building the so-called foundation models. And there's sort of a big fight between a view of the world in which there will be a few big models that basically win everything, and then an alternate view of the world in which this is more like the microprocessor, and there will actually be many thousands of different models running on billions of devices, of many different shapes, sizes, descriptions, customized in various ways. And actually that latter thesis is the thesis we're investing against very aggressively.
Mm-hmm. Now, you said last year that we should just stuff AI into everything we do, like weapons, cars, everything, in order to beat the Chinese. Could you tell us about it?
Yeah, there's sort of two policy debates happening around AI, and somewhat for sure in the EU, but for sure in the US. And there's sort of one policy debate, which is AI is sort of weird and scary, and we should regulate it, and we should kind of prevent it from happening in different ways. And the EU has put in place these kind of very onerous regulations. The UK has followed, and then there's a big fight happening in US politics around this. And so this is sort of an inward-looking, kind of domestic policy viewpoint, and people have all these fears around AI. There's a completely different conversation, which is the geopolitical conversation, and that's the conversation of basically geopolitical competition with China. And of course, the minute you get into that conversation, it becomes very clear that we need to win. And specifically, the reason we need to win is we need to win the AI race with China. Sort of a very analogous way that we won the sort of technology race with the Soviet Union. In the previous century, which is, we have two basically dominant, mindsets, regimes of, Western democracy and Chinese communism, that both have aspirations to transform the world. Both of those are supported by major nation states. Both of those are supported by major militaries. Both of those are supported by major economies, and both of those are supported by major tech industries. And if you look at the precedent of the Cold War with the Soviet Union, the reason the West won was because of sort of a triangle of technological superiority, economic superiority, and then national security, military and intelligence superiority. But we decided we wanted to win, and we won. Right. And by the way, our victory ended up actually being great for the people of Russia. Right. It was actually really great for the Soviet Union to fall. And people in Russia are much better off today. And so, I think this is very straightforward. Like we need to win. We need to win by being better technologically, better economically, and better militarily. AI has been identified as the core technology for the future of the nation state by both U.S. military planners, by the Pentagon, as well as by the Chinese planners. And so it will be one of the main areas in which these kind of the two hemispheres compete, and I think it's important that we win.
Where do you think the West is now relative to China?
So the West has, I would say, all of the advantages and disadvantages of a decentralized system and a market economy and a sort of a system in which governments don't control everything. And the huge advantage of that is innovation and entrepreneurship. The disadvantage of that is it's very difficult for our systems to plan. There is no top-down American technology strategy. There is no top-down European technology strategy. Those concepts are kind of, antithetical to our systems. And so we're very robust and dynamic in general, but, we're very messy. The Chinese have both the advantages and the disadvantages of a centralized system, much like the Soviet Union did. They have a command and control system where the Communist Party, owns and controls everything, and they can direct their private companies to do whatever they want, which they're doing right now. With sort of increasing force. And then they have all the disadvantages of a centralized system, which is, they have a command system. They're actually in the process of trying to crush their entrepreneurial system right now. They're trying to basically drive their entrepreneurs, out of in many cases out of business, in many cases out of the country. And so it's just like the Cold War with the Soviet Union. It's an asymmetric situation. Each side brings strengths and weaknesses. And then I would say, each side is tempted to embrace the model of the other side to try to get the advantages. So the Chinese have kind of this fake entrepreneurial system, that they kind of try to foster, and then we have this sort of, not very effective, central planning function, in DC and in Brussels, that doesn't work very well. And at least I would argue we should lean into the strengths of our system, and try to benefit from the fact that we should have a much more dynamic economy. We should have much more entrepreneurship, and hopefully that's what we'll do.
Talking of dynamism, when we met, you also talked about the importance of investing in American dynamism, and I guess that also goes for European dynamism. What do you mean by that?
Yeah, so look, this is sort of part of this is part of the challenge for the geopolitical conflict as well as our domestic issues. And so look, both the U.S. and EU. I mean, we are the result of the Industrial Revolution, right? We are a result of the first Industrial Revolution with things like steam power. We're the result of the second Industrial Revolution, with things like electricity. We're the result of the computer age. The West, represented by the U.S. and Europe, is where most of these technologies over the last 300 years were developed. And historically, our society's benefited enormously by this. We have the highest standards of living. Our children over time have done the best, and generally it's been a very synergistic, positive process. In the last 50 years, I think both American society and EU society has sort of lost faith in the idea of technological progress, and lost faith, frankly, in the idea of economic progress, and decided to become, let's say, much more cautious, much more risk averse, much more unwilling to think of change as a positive and exciting thing. And you actually see that I would say in America right now. The relationship between industry and the government is at a 50-year low. It's actually quite a large amount of hostility between government and industry, and the same is certainly true in Europe. And so our view is like, look, we need technology. We need technology. We need innovation. We need markets. We need these things to function. Why? Because we need growth. We want our societies to be growth societies. We want people to think that there's opportunity. We want people to be able to think in positive sum terms. We don't want people to think in terms of like, for me to get something, I have to take it away from somebody else. We want to, think about our society as societies that can grow and flourish, where our children will do better than we do. And so American Dynamism is sort of a very direct investment program that we have, focused on injecting a lot more technological energy into a lot of the sectors of the economy that the government's very involved in. And certainly defense and intelligence are a big part of that, but also energy and law and education and healthcare are also big parts. And all of these sectors, frankly, I think they're really suffering from a lack of technological change and innovation, and they could really use it.
What would be the key to get Europe to become more dynamic? I mean, not that we are not dynamic in Europe, but compared to Silicon Valley, we seem to be lagging a bit behind here.
Yeah. So look, if you did a rank order of the top 50 technology companies 30 years ago, a large percentage of them were European. I think it was about 40%. If you did a rank order today, I think it's 1 out of 50. And so, Europe has really fallen off. And I guess the way I would describe it is it seems, at least from the outside, it seems to be almost entirely choice. Which is, it seems like it's been a choice to sort of prioritize regulation and risk aversion and the precautionary principle over innovation. The most acute version of that, obviously, is the energy sector. With the sort of voluntary stand down of energy development, which I think has led to real geopolitical stresses with respect to Russia. And so I think it's been a choice. I think the political leadership class in Europe has decided that they want this. The voters so far have supported them in wanting it. It has consequences. I think the consequences are becoming clearer. I think fundamentally it's a choice at a societal level. And the voters will either step up or they won't, and the leaders will either step up or they won't. But I think the results of the current approach are in, and I don't think they're very good.
Any reflections on your responsibility as a venture capitalist or venture capital investor at a time where technology is becoming so integrated into the race between the superpowers? Elon Musk with Starlink suddenly being key in Ukraine, and so on. How do you think about it?
Yeah, so I would describe it as we're 100% on the side of the United States, and we're 100% on the side of the West. And so we never, as a firm, for example, had an investment program in China. We always viewed that there would be difficulties from that, which for a long time, looked like a mistake, but I think is now increasingly clear. So we're 100% on the side of the U.S. and the West. As a firm, we don't have our own foreign policy. We have basically the foreign policy of the U.S. State Department, and so we're sort of in complete lockstep with our government. All of our programs that involve anything involving national security will be based on the U.S. government's view of friends and allies. I would say this, this was a controversial position basically up until Russia's invasion of Ukraine. And so up until Russia's invasion of Ukraine, basically there was a prevailing ethos in Silicon Valley that national security is somehow bad or undesirable, or that tech companies should not want to, be involved in it. And there was this famous incident where Google had this program with the U.S. Department of Defense that their employees basically rioted on campus and forced them to cancel. At the same time that Google actually had, an AI lab in Beijing that by definition is, anything in China is sort of connected to their security state. And so, there was a fair amount of, I would think, internal dissension, division in Silicon Valley in terms of what the right role is, between the Valley and the U.S. government. Basically, what we've observed is the minute Russia invaded Ukraine, it was obviously a catastrophe for Ukraine and a terrible thing, and I wish it hadn't happened. But it caused sort of an instant sort of like a depolarization of this issue, certainly in the U.S. and in the Valley, where all of a sudden people who historically had been very averse to tech involvement in defense all of a sudden became very in favor of it. The most vivid example, there was this company Anduril that was a very politically controversial company, our new defense contractor, building all these automated defense systems. It was a very controversial company in the Valley, basically right up to the day Russia invaded Ukraine, and ever since everybody loves it. Which the founder of that company points out. There's some irony to that because the company's doing the same things. But I think the Russian invasion of Ukraine really highlighted for a lot of people, including a lot of people on the political left in the U.S., that actually national security really matters, and there are actually bad people in the world, and there are going to be invasions, and there are going to be bad things that happen, and the Western democracies need to be able to respond and need to be able to be state of the art, being able to cope with these situations. And then, of course, the the attack in Israel, is a sort of a second, again, another terrible thing, but a second kind of factor that has caused people to say, okay, we need to make sure that Western democracies are actually armed up.
Yeah. Marc, finishing off on a completely different tack here. In 1 minute, how can we become better investors? Because that's the theme of the conference.
Yeah, so I think the question always, I think the question for sort of large institutional investing, the question is, deployment of large amounts of capital. There just are not that many places in the world to get growth. And so, the fundamental challenge every large scale investor I talk to deals with is, most of the capital that they invest, just kind of by definition can't go into high growth sectors, just because there aren't that many high growth sectors. They're actually, quite hard to find. And so there are basically a small number of places in the world that have growth. There are a small number of people who are starting the kinds of companies and trying to build the kinds of industries that are going to be able to deliver growth. And so, and generally speaking, Western investors are quite supportive of this. And so, venture capital is quite well funded. But, I think focusing in on specifically the places and the people who are going to be able to generate growth. And then, quite frankly, the other thing is, it's very helpful when these investors also weigh in more broadly than just with money, and also weigh in with their influence and with their level of authority and their level of persuasive capability and so forth in their societies. The growth is something that we should be aspiring for, and that is actually good, not just from an investment standpoint, but from a societal standpoint.
Fantastic. Well, big thanks for sharing your thoughts with us, and all the best of luck going forward.
Great. Thank you very much. It's great to be with you guys.
Now, before we share next year's program with you, I just want to say a big thank you to everybody who's made this conference possible. We've had a lot of people working behind the scenes, so if you wouldn't mind just helping me, giving them a bit of applause. And then next year's conference is going to be something very different from this year. You may remember that we had the CEO of Ferrari on the podcast a little while back. Now, he was very keen to come to Oslo to cook. He's very keen on his reindeer. Now, a lot of people want to join the CEO of Ferrari when he comes to Oslo. So we have a preliminary lineup here. In addition to Ferrari, we have the CEO of Novo Nordisk, which is now the largest company in Europe. We have DoorDash, which is the biggest delivery company outside of outside China. We have Otis, which I think in a way is exemplifying the importance of recurring revenue streams. It's an elevator company. If you don't pay your maintenance, there is just going to be no service. We have Nestlé in terms of pricing power, talking about the importance and how you build brands and how you do that. We have Adidas, Bjørn Gulden, coming to talk about brands. And then lastly, Elon Musk has also said that he's coming, but this is not a super final program yet. But we, things can happen. But I think this looks really good. 29th of April next year, put it into your diary, and we will send out invitations in January. That was all for the streaming part of things. So everybody who's followed us on stream, a really big thank you. See you again in April next year, and all the best.